hosting Adelaide Capital's Mid and Small Cap Energy Topic Conference. We think it's a great time to be exposed to the energy market for the following reasons. Prior to the Russian invasion in Ukraine, the world was already experiencing the effects of 7 years of underinvestment in oil and gas capital expenditures. Tight supply has been exacerbated by an inefficient transition to renewables, a return to pre-COVID levels of demand, and the ongoing Russian-Ukraine war. At a time when inventories of oil and products are at extremely low levels, current events have led to significant increase in the prices of oil, natural gas, and related products, and supplies are only expected to tighten. Escalating gasoline prices, an extreme global shortage of diesel, soaring costs related to heating, transportation, production, factor into everything we buy. Higher natural gas and diesel prices have contributed to skyrocketing fertilizer costs, and the UK and Germany's reliance on Russian gas and oil is resulting in calls for increased supply. E&P companies right-size themselves after the 2020 downturn and have never been better positioned, yet are trading at historically low multiples. Our Top Energy Picks conference explores current market conditions and features what we believe to be the best managed companies with the best assets poised to offer superior performance to investors. We will begin with company presentations, followed by our keynote speaker, Rafi Tamazian from Canoe Financial. If you have any questions, post each presentation, please enter them in the Q&A box or email me directly for questions or one-on-one requests at jessica@adcap.ca. As always, presentations may contain forward-looking statements. Today, we are joined by Ashley Hardcastle, Controller of Surge, and Derek Christie, Senior VP of Geosciences. Surge trades under the ticker symbol SGY and on the OTC at ZPTAF. Welcome, Derek and Ashley.
Thanks, Jessica. I'm going to share my screen now.
Congratulations on an exciting quarter for you guys, by the way.
Thank you. So thanks, Jessica. So I'm Derek Christie, Senior Vice President, Geosciences here at Surge, and with me is Ashley Hardcastle, the Manager of Corporate Finance. Just jumping into the Surge story, I'd like to highlight a few key components of the company. So firstly, we focus on high operating netback, conventional resources with large original oil in place with low current recovery factors. We then use a disciplined capital allocation strategy to develop our low risk drilling inventories in really our core areas of the Sparky and Southeast Saskatchewan. Led by Paul Colburn, we have a proven experienced management team with a strong track record of execution. And really what this results in is the generation of significant free cash flow and really provides visibility to shareholder returns. Looking at Surge's net asset value, so utilizing our most recent SPRO report dated December 31st, 2021, and then utilizing that SPRO price deck, which is really equates to about a $70 WTI flat deck, we end up with on a total proved basis, $9.81 per share. And then when I think of that on a P plus P basis, that's $16.94 a share for Surge. Looking at the right-hand side of the chart here, we've run some sensitivities, and you can see that highlighted in green is that $80 deck. So, just $10 higher than the SPRO deck and significantly lower than where we are trading today. You can see that's $15.55 a share on a total proved basis. And then that jumps to $24.34 a share on a P plus P basis.
So in addition to the net asset value that Surge offers shareholders, Surge has also been independently recognized as having one of the top free cash flow yields in the Canadian energy space. So the two charts on the right here are done by independent investment firms, the top being done by Peters & Co. out of Calgary. And it shows that on a debt adjusted basis for 2022, Surge will have a free cash flow yield of 42% compared to the peer average of 33%. And then down below, the chart was done by 9 Point Energy Partners and shows in 2023, Surge will lead the group again at just under 40% free cash flow yield compared to an average of 23%. And in addition, Surge has accumulated approximately 1.3 billion in tax pools that will shelter the free cash flow that we're generating and provides an attractive multi-year tax horizon. So this slide sets out the macro backdrop for the run-up in crude pricing that we're seeing. So there's been a chronic underinvestment in the oil and gas industry over the last several years, which is now resulting in significant draws on crude inventories throughout the world and in the US, which has many analysts calling for crude to reach well over $120 US as economies reopen and demand picks up. This slide highlights how energy is a great natural hedge against inflation for investors. So very topical today with the inflation that we're seeing. US inflation is now posted over 8% and Canadian inflation is just under 7%. And oil and gas stocks have a track record of outperforming the market during these inflationary periods, as you can see in the chart here. Surge's 2022 corporate guidance is focused on shareholder returns and enhancing free cash flow. So we are forecasting production of 21,500 BOE per day for the year on a sustainable capital budget of 124 million. So at $85 WTI, this will generate 2022 cash flow from operations of 295 million and 2022 free cash flow of 170 million on an all-in payout ratio of 42% and an exit debt to cash flow ratio of 0.55 times. Last week, we were very excited to press release that we're accelerating our return to our shareholder returns business model. So on July 15th, Surge is anticipating reinstating our base annual cash dividend of 42 cents per share, which equates to 35 million per annum. And we did reconfirm the extension of our $150 million first lien credit facility, which was drawn less than 100 million at March 31st. And that we are in receipt of an incremental 30 million of term debt financing, which we plan to use to retire our convertible debentures that are coming due at the end of 2022, which all lends itself to a simplified debt capital structure for the company, significant liquidity, and no debt maturities through mid-2024.
That's great. Thanks, Ashley. So the next few slides, I'm just going to walk through some of the details of our asset base and really help to differentiate the kind of our location inventory and just highlight some of those things with that. Surge is really focused on the conventional side of the reservoir spectrum. So when you think of truly unconventionals being the Duvernay, the Permian, the Montney, and then you think of conventional reservoirs being the Sparky and Southeast Saskatchewan, we're really focused in that conventional side. So really what that means is that we have greater permeability on the conventional side of the spectrum, which is really higher reservoir quality. What that gives us is really lower capital risk and lower decline profiles, ultimately resulting in greater IRRs and PIRs, so just greater economics, internal rate of return and profit investment ratios. And then on top of that, because we do have these conventional reservoirs, it really offers the low risk, predictable, repeatable development and the opportunity to improve recovery factors through really, when you think of that, through water flood, which helps to really mitigate decline rates and just adds low cost barrels. On this slide, it really summarizes the company in a nutshell. When you see fundamental to what we have is 2.6 billion barrels of oil in place over our resource base. Thinking to, based on recovery factors, that's 6.5% cum to date from that. And then when you think back to the independent reserve report that we discussed earlier, that's 9.6% on a booked recovery factor basis. Looking at analogous pools to this, we see primary production recovery factors of up to 20. And then when you think of water flood, up to 30%. Really, so when you think of that in context, just a 1% change in recovery factor based on this is, 26 million barrels of recoverable oil. Then looking at the total booked drilling locations, so that's 456 booked drilling locations associated with that reserve report, but then our total inventory is over 950. So again, a great runway to see that improved recovery factor. The next few slides will go through just the details of our top plays being the Sparky and Southeast Saskatchewan. Importantly, 2/3 of our production come from these two core areas, and then 85% of our capital spend in 2022 is in these two core areas. Obvious question is why? Why are we spending all of our money in these two core areas? Well, if you look on the right-hand side here, this is some independent research that was done by Raymond James, ranking all of the top oil plays in Canada. The criteria for ranking was when a well reaches its second payout. So you drill a well, you get your money back. When do you get your money back again? Then they ranked all those plays. The top plays that kind of rose to the top were our Sparky in Alberta, Southeast Saskatchewan conventional, the Clearwater, and the Charlie Lake. You know, when you look at our two core areas being the Sparky and Southeast Saskatchewan, that makes up 2/3 of our drilling inventory. So we're exposed to these two of the top four plays, but importantly, 2/3 of our inventory lie within these plays. A little bit of detail on the Sparky. The Sparky is part of an 11 billion barrel oil trend, one of Canada's largest accumulations. We're really focused in the light to medium gravity window, which is greater than 20 API. So of that, there's 4 billion barrels in that light to medium gravity window. And importantly, we see 20,000 vertical wells that have been drilled in this part of the Alberta. So it gives us a lot of geological data. We incorporate that with 3D seismic over all of our existing pools. And then we utilize all of the engineering modeling that we have to just end up with a really integrated reservoir model that helps to de-risk our past drilling. So we've drilled 200 successful wells, multi-stage frac wells. And then going forward, it helps to really de-risk our go forward runway of 400 drilling locations in the Sparky. As I highlighted before, you can see where the Sparky ranks. It's in the top 4 of the 2 times well payout. And then one of the real key factors here is that we have low cost to drilling. So that's 1.3 million on a drill complete equipment tie-in per well. Deep inventory of 12 years. Great economic netbacks. And then we see that 800 million barrels of oil in place net to surge here, more than 400 drilling locations. And then we have really grown this from essentially zero through some strategic acquisitions and core drilling. We can see we've grown that to 9,000 barrels a day. Something that's reasonably new for Surge this year is our re-entry back into Southeast Saskatchewan. So through some really strategic acquisitions last year of Astra and FireSky, we re-entered this area. It's an area that certainly Surge is familiar with, having worked here in the past. Myself and Paul Colburn have had numerous companies that we've worked with down here. So we saw this as a real great opportunity for Surge. We like it for a number of different reasons. One of the main ones is just the great capital efficiencies we see down here. Very low cost of drilling. These are $900,000 per well. And really what the low cost is that we do not need to frack these wells. We're drilling conventional horizontal wells and then just producing them. So it really gives for some great quick turnaround. Out here, we see lots of good organic opportunities. And I think that's really highlighted by some of the recent land sale activity where we're able to do some organic mapping and come up with some great opportunities that we've developed down here. Again, why do we like Southeast Saskatchewan? So it really ranks in the top of any oil play. We see $60 netbacks at $85 WTI. We have more than 250 drilling locations. So again, we have an 8 to 10 year drilling inventory out here. Through the 2 acquisitions of Astra and FireSky, great asset base of 5,000 barrels a day and really great capital efficiencies. So between the 2 plays in the Sparky and Southeast Saskatchewan, it really gives us a great framework to be able to develop our inventory here.
So moving to ESG, Surge has a very strong commitment to ESG and being a sustainable operator, which is highlighted by our actions. So we did publish our inaugural ESG report in December of 2021, and I encourage anyone that's interested in reading the report to go onto our website and take a look. And then we also completed several important ESG projects in 2021. So we did abandon greater than 260 wells in the year, which represents abandoning 5 wells for every well that we drilled in the year. And then we completed 2 significant gas conservation projects, a 45-kilometer gas gathering system in Southeast Saskatchewan, which allowed us to reduce our Scope 1 emissions by 45% in the area. and then a gas conservation project in Southwest Saskatchewan, which allowed us to conserve 70% of our Scope 1 emissions in the area.
So just to finish off, you can see that we have a fairly deep analyst coverage here. And that helps to really just solidify our story. And we're really excited about where we're going. We've developed a great asset base, and we definitely have the inventory to continue on, and really excited about where Surge is going in the next year.
That sounds great, guys. It definitely had a lot going on in the quarter. Let's touch on your Steelman discovery a little bit, if you don't mind. As you said, you had great success at a land sale just recently. Are there other small producers or land that you can pick up in the area?
Certainly, that's one of the things that attracted us to Southeast Saskatchewan were the organic opportunities that we see. We're always looking for small opportunities that can help to upgrade our inventory. But as I showed in the previous slides, we really don't need to do anything, but we're always looking for accretive acquisitions that can help us to solidify and upgrade our inventory.
Okay. Now, two of the wells you've drilled in that area have been two of the top in the country, which a lot of people are starting to take notice of. Out of your 40 locations at Steelman, how many of those do you think are tier 1?
Sure, that's a great question. 25 to 26 of those would rank in the top tier 1 locations that we have in the company. So again, about 2/3 of those would be tier 1 locations for us.
Okay, so that's pretty exciting. Does this change now Sparky's very economic, obviously, as well right now, but Steelman's a little bit more economic. Will this change your capital allocation at all as far as your CapEx goes?
It really won't, but the addition of these tier 1 locations, really it won't change our capital allocation between the Sparky and Southeast Saskatchewan. We do really like what's going on in both of those areas. But I will say that the capital allocation within Southeast Saskatchewan is going to change slightly. So we're going to be drilling a few more wells in Steelman. And in fact, we'll be drilling up to 6, maybe even 8 wells on the newly acquired lands in the back half of the year. So really doesn't change our approach overall, but it will just, in the specific area of Southeast Saskatchewan, will change it slightly.
Okay. Now also, you implemented a dividend, but it still leaves you with a lot of free cash flow, as we saw in your presentation. Now, how do you expect to allocate that for the rest of the year? You're going to focus on some more debt repayment, but do you think you'll increase dividend, do a special dividend, or would you focus on buybacks? And would you increase your CapEx?
Yeah, good question, Jessica. So certainly our number one goal right now is further first lien debt repayment. So we had about $100 million drawn on our first lien facility at March 31st. And we'll look to have almost nothing drawn on the facility by the end of the year. And then from there, subject to board approval, we will also look to pull other levers, such as implementing share buybacks, strategic M&A in our core areas, as well as potentially adding in a growth wedge to our capital program.
And so that would be your ideal amount of leverage you would like to have in the company, sort of 0.5 times debt to cash flow, that the most efficient use of capital?
Yeah, we feel that's a good leverage ratio. And then we are looking to largely repair first lien facility. And then we will continue on with the 5-year term debt facility that we have currently drawn.
Mm-hmm. Okay. Now on your ESG side, maybe we can touch a little bit more on, because you've done a lot of work on ESG, and if you want to explain in a little more detail, if we could go back to that slide maybe, and touch on, the gas gathering and the how that helps your GHG emissions, etc.
Sure. So yeah, for the Southeast Saskatchewan, that was a gas tie-in project. It's 45 kilometer gas gathering pipeline that we've installed. And it is going to reduce our scope 1 emissions in Southeast Saskatchewan by 45%. And then we have another project that we've done in Southwest Saskatchewan, which is a gas conservation project. And then that's designed to reduce our scope 1 emissions in the area by 70%.
Okay, so can you explain a little bit more to me about how the gas conservation project works?
Are you able to take that one, Jared?
Yeah, sure. So we built that gas pipeline, and then we're able to conserve the gas from all the independent batteries at a central facility. So that's really, so we're able to reduce our flaring by tying that into the common facility through the major pipeline.
Okay.
Yeah, and an added benefit right now with gas prices being so high that we're able to conserve that gas and send it to sales.
Oh, certainly. Yeah, that is helpful to be able to capture that where as opposed to flaring. Now, do you have other projects like this planned, or do you need any more projects like this? Do you think you've done the heavy lifting and now just focus on abandonment?
No, we are going to have a continued ESG budget every year. So we are putting together an inventory of GHG reduction projects that we can work through. So we'll implement more for reducing our emissions, and then we'll also continue with our strong abandonment programs. So we are anticipating spending 10 million in 2022 on abandonment work as well.
Okay, thank you. And what would be your total abandonment liability on your balance sheet?
Yeah, so it's just about 300 million right now for our ARO location. Yeah.
Yeah, 300 million, which is obviously amortized over what period?
Yeah, and that's on an undiscounted basis.
Just okay, thanks.
And maybe I can just touch a little bit on inflation, because that seems to be a fairly topical discussion these days.
Yes.
I can talk about kind of what we saw in Q1. So going from 2021 into this year, we budgeted about a 12 to 15% inflation. So we're really happy that we were able to stay on budget with that going into Q1. We are seeing a little bit of cost pressures for the back half of the year, so monitoring that very closely. But then doing everything we can to really secure our services. So we'll be starting drilling here June 1st with 2 drilling rigs in the Sparky and then 1 in Southeast Saskatchewan. So really happy to have that equipment tied up. Seeing quite a bit of pressure on steel prices. So we're doing everything we can to pre-purchase a lot of our casing. So really, I'd say about 50% of our capital program we have locked up those costs, and happy to say that we have locked up the services to do that.
So you've locked up your entire service, all your services till year end?
Well, what we can. So we would have locked up the drilling rigs and then, made commitments to the additional services that we have. As I mentioned, that we don't have to frack our wells in Southeast Saskatchewan. And then we're also doing smaller fracks in the Sparky. So we don't have the high intensity fracks, but we have lined up those services as well.
Okay. We did touch on Steelman. Do you want to talk anything about anything on your Sparky program that you've just completed?
Yeah, sure. So we completed 18 wells in Q1. Of that, we've got about from the total program, it's about 2,000 barrels a day that we've BOEs a day that we've got from that program. So results as expected or better than expected. When we move into Southeast Saskatchewan, we drilled 8 wells in the quarter. Total BOEs from those is about 1,400 barrels a day current production. And then we've recently completed a well up in Valhalla. We drilled a Doig well, a 50% Doig well. Just starting to see those initial production rates, but really excited about that as well. So overall, we finished up our program. And now just kind of gearing up for the second half, which again, will be starting in June 1st here.
And those Valhalla wells, if I recall, can be quite significant.
Yeah, for sure. So, some of the wells in the past would be 1,000 or 1,500 BOEs a day. We're hoping for something around that 1,000 BOE a day mark would be a success for us out there.
Okay. And looking at this, and then you start obviously a lot of this is flush, but and you're still forecasting 21.5, but it looks like you could, without adding any CapEx, potentially have an increased year production.
I would say that our production is on track right now. So that's, as we've forecasted out the wells that we have drilled, this is what we have been expecting for our forecast. So at this point, I would not say that we'd be bumping our production forecast.
Okay.
But on capital.
Okay. And when can we expect an ops update in your Q2 report, or do you think something prior to that?
Probably not prior to that, but we'll do like we usually do, a fairly fulsome ops update when we do our next quarterly release.
Okay. And as we did talk about A&D, and you do have a lot of locations, but are you seeing anything that's interesting in, let's say, Alberta as well?
There is quite a bit in the market, but I think as we've shown with our asset base, we will be very disciplined because we have a great asset base as it sits. We do not need to go out and do anything that would be non-core, that's for sure. And anything we do would have to really make us a better company. So we're looking for, strong accretion across the board. We do see some opportunities for some core area top-ups, and we're continuing to work those. So also, when we think of the organic opportunities, just like we did in Steelman, we're continuing to work up that organic opportunity list. We have done some things in the Sparky as well, maybe not quite as big as what we saw in Steelman, but always continuing to add to our core area through our organic opportunities. Okay.
So you think you maybe have some organic discoveries in the Sparky area that could expand?
Yeah, I don't know if I would call it a discovery, but we're continuing to push the edges of the play and
push the edges. Yeah. Okay, that sounds great. And any estimates for exit production for this fiscal year?
Sorry, you broke up there.
Oh, are you willing to give an exit production rate for this year at this point?
Yeah, I would say not at this time. I think you can just say that we're on track for our 21.5 average.
You see, I'm really pushing you to try and get you to say higher. I don't think I have any other questions at this moment. Anyone else from the audience have anything? Is there anything else you guys want to touch on?
No, I think that we hit the major parts of it. Again, really excited about the program we just finished off. Then really looking forward to the balance of the year. I think one thing that really differentiates Surge from others is just the quality of our asset base. And we're starting to see that, and you can see from our results, and then just our depth of inventory across all of our plays. So I think that's a real differentiation for Surge.
Well, historically, you were really one of the only companies drilling in the lighter portion of the Sparky, right? So, you were getting as much attention as potentially some other companies who were, when you have 4 companies drilling in the Clearwater, as opposed to. So, I think now people are really taking notice of the economics and the, the size of the Sparky.
Great. Okay. Well,
thank you. Yeah. Thanks for your time. Hi, next up we have Wade Hutchings from Enerplus. Enerplus trades under the ticker symbol ERF on the Toronto Stock Exchange and on ERF on the New York Stock Exchange. Hi, Wade. Wade is a senior VP and COO from and welcome today.
Thank you. Pleasure to be here.
If you want to, are you going to show your presentation?
I will, yes. Give me one moment. Okay, is that coming through properly?
Yes, it is.
Okay, great. Well, just let me know if it's not. I cannot see the projected screen, so we'll assume it's working unless you let me know otherwise.
Okay, now I'm seeing your emails.
Well, that's probably not good.
Wow, is there anything exciting in those?
There could be. Okay, so are you seeing the? What are you seeing now?
I'm just seeing a blank screen now.
Okay, let me see here.
If you send it over to me, I can share it for you if you want.
Let me do that.
Oh, I'm having trouble. There we go. Hang on.
Okay, I think I can share it from another method here. Let me see.
Okay. You and I can maybe go to a tech class together.
Yeah, we could try that. Okay, how is that?
Perfect.
And is it in full screen mode?
Yes.
Okay, well, thank you. So we'll go ahead and get started. Thanks for your patience. Thanks, Jess, for the invite, and really appreciate all the participants for your time and for your interest in Enerplus today. Just confirming that has advanced the slide, Jess?
Yep, it's working.
Okay, perfect. So just our customary forward-looking material. And so today we think of the company as strategically having one single core asset, and that's the Bakken. The Bakken, in our mind, is a differentiated position within the basin. We see ourselves as having the most remaining tier 1 drilling inventory among similar sized companies. In fact, that inventory represents well over a decade of inventory. We have a long track record of capital discipline and returning capital to shareholders. In fact, the company has returned over 60% of free cash flow to shareholders through both dividends and buybacks since 2017. We also have a long track record of operating with low leverage, with the last 5 years having been at or below 1x net debt to funds flow. We remain well positioned to continue this track record, and given the strength of our inventory and the continued prudent approach to managing through price cycles. So let me turn now and just give you a couple of highlights from our recent Q1 earnings release. So the key thing we announced last week was a increased return of capital to shareholders framework for this current year, where we committed to returning a minimum of $350 million or 50% of free cash flow, whichever was greater. We expect to generate over $675 million in free cash flow based on $85 WTI and $5 NYMEX. Of course, strip is higher today. We increased our annual production guidance based on strong execution and the ability to optimize our forward development plan. We also talked about how we were managing the inflationary environment and noted that the actions we took in 2021 to secure crews and equipment and services for this year continues to protect us against what we're seeing out in the market. We also have started the year out really well from an execution perspective with our rig and frac crews that we've been using for quite some time. And then lastly, we noted that our intention was to continue to maintain capital discipline and that we had no plans to chase further growth as we see that would come at less efficient capital. Moving on to a summary of our 2022 plan, what you can see here is a capital plan in the range of $400 to $450 million. This is based on a 1.5 rig program, which is designed to deliver low single-digit organic production growth, represents a reinvestment rate of just under 40%. The plan is expected to deliver robust free cash flow and significant year-over-year free cash flow growth. The chart on the right is showing our 2022 free cash flow yield at different oil prices. And you can see that based on our current valuation, our free cash flow yield is north of 20% based on oil prices above $80 WTI. Let me shift now to a little bit of detail on our 2022 capital allocation plan. You can see here that $85 WTI, we expect around $1.1 billion in cash flow, less our CapEx plans and the $40 million annual dividend leaves just under $650 million of excess free cash flow. Today, we plan to prioritize share buybacks and debt reduction with this excess free cash flow. And if you recall, we made a commitment at the quarter where we would commit to at least $350 million or 50% of the free cash flow returned in the form of dividends or share repurchases. Let me give you a little bit more detail to that return of capital commitment. What you can see here is that if you look beyond the $40 million annual dividend that we just announced, we plan to return a minimum of $310 million to shareholders this year. As we've noted today, we're prioritizing buybacks as the principal return mechanism, given the disconnect that we continue to see in our share price compared to the intrinsic value of the company. And we base that intrinsic value on what we view as mid-cycle prices. Now, the chart on the right shows the total return of capital at different oil price decks. Effectively, at prices above $85 WTI, will return more than the $350 million minimum commitment. You can see at $95, that would be $370 million. That kind of capital return represents greater than 10% total cash return yield, dividends plus buybacks, based on our current market cap. Now, if our shares reach a valuation that doesn't justify buybacks, we will return the committed capital to shareholders via another dividend mechanism. Let me now shift to how the business looks over the longer term. So we've provided this 5-year view that's focused on generating sustainable free cash flow. The plan is very much levered and focused on the Bakken, where we see the vast majority of investment and the vast majority of cash flow generation. The annual capital of $400 to $450 million is expected to continue to drive a 3 to 5% production growth and generate $2.3 billion of cumulative free cash flow. Now, a key point here is that this plan is based on a $70 WTI price environment. So in a higher price environment, we would expect some inflationary pressure on the capital spending, but this would be more than offset by the higher cash flows. So even in this $70 WTI environment shown here, we would expect to free cash flow at least 3/4 of our market cap in that 5-year window. Now, let me make a few comments on our approach to good governance and safe, environmentally sound operations before I dive into some more details on the Bakken asset. So we're now at a spot where we have deeply integrated ESG strategy within our operations with strong board oversight. We've identified 6 material focus areas that we believe will reduce risk and support long-term business resilience. You can see that those 6 areas on the image to the right. Now, a few highlights from 2020-21 performance. We reduced our GHG emissions intensity by 25%, and we continue to work towards our longer-term target of a 50% reduction by at least 2030. We also had great success reducing methane intensity. We had set a 2-year target to reduce it by at least 20%, and we were able to achieve that and more in the first year. We also have continued to find ways to integrate the use of produced water in our fracture stimulation program. And by doing that, we've reduced our freshwater use by 31% last year. And then lastly, we're very proud of the exceptional safety performance we had last year, where we operated the entire year without any lost time injuries. So integrating these kind of actions throughout the company and our operating practices are not only continuing to deepen our ESG performance, but we're actually continuing to find that they're driving further efficiencies to cost, cycle times, and other key operating metrics as well. Let me shift now and dive into some more details around our specific Bakken position, but let me start out with a comment or two about the Bakken in general. So if you look at this chart of break-even levels for different plays in the US, you can see how the Bakken stacks up. Now, we believe that the Bakken has and can get overlooked a bit by investors due to it being one of the more mature shale oil plays in North America. Some have even said, you know, the inventory in the Bakken is almost all played out. And I'm here to note and tell you that's simply not the case. It's not correct. We actually think that the Bakken continues to have several structural advantages that makes it an attractive investment in oil and gas. So the first is that there actually does remain a fairly substantial drilling inventory in the basin. Based on our own analysis and external third-party analysis, we see well over 10,000 drilling locations that remain viable at or below $60 WTI breakevens, representing close to 15 years of additional drilling at today's activity. Now, importantly, the core of the Bakken, which is where virtually all of the Enerplus inventory is, as you can see on this chart, competes with the best oil plays in North America. The break-even chart highlights the core of the Bakken, represented by those 2 yellow bars for Little Knife and FBIR, or Fort Berthold Indian Reservation. That's where 85% of our next 10 years of inventory sits. Now, in addition to this long runway in the basin, the Bakken also benefits from one of the most supportive regulatory frameworks in the country. And lastly, the basin has significant takeaway infrastructure, which supports a strong oil price realization forecast for the future. Let me shift and give you a few more bits of detail and color around the Enerplus inventory. So as you zoom into our position, you can see that we are representing over a decade of core drilling inventory. That's shown in the dark gold on that bar chart. And that inventory is what supports not only our 5-year growth plans that we've talked about, but really supports a decade of growth that we can see in front of us right in the core of the play. Now, the core of the play is what we consider to be the best subsurface conditions to drive great well performance. And it's an area that's very well established, it's very defined, it's de-risked. And for Enerplus, it represents our FBIR, northern Dunn, and eastern Williams County areas. Now, on top of that decade of core inventory, we see another couple of years of inventory that we would call extended core. Naturally, this is an area that sits just right outside the periphery of the core, and they have slightly lower returns than the core. But at today's view of mid-cycle prices, that inventory would exceed our return threshold, and we would certainly see it being developed over the longer term. And then lastly, beyond that, shown in the gray on the bar chart, we have several more years of upside locations, which we view as offering potential if we either remain in a higher commodity price environment, or if we can continue our track record of improvement of well costs and well performance through efficiencies and technology application. Next, let me shift to a little bit of data that supports what we view as a high quality differentiation between the Enerplus inventory and the inventory that sits there in the average peer in the basin. So this chart shows quite a bit of data. And so let me just describe a little bit of it for you. So if you look on the left axis, you'll see remaining net locations. And then the stacked bar charts for each of the companies listed is broken out by quality. And it starts at sub 45 WTI. You can see that we've ranked the chart on sub 50 quality. That's the dark green level. And this third-party data that we're showing here at a basic level simply shows that Enerplus ranks third in terms of having that high-quality core inventory remaining in the basin. But we want to go a little bit beyond just that basic ranking. So if you look at the right axis on the chart, it shows in-basin production. And then if you look along the top of the graph, you'll see that we've also divided each of the companies by market cap, with the dark blue representing greater than 10 billion market cap and the light blue under 10 billion market cap. So importantly, when we look at the inventory now compared to market cap or in-basin production, you can see that Enerplus's inventory stands out even more, hence the differentiated position that we've talked about. So you can see there, among smaller cap producers, Enerplus has the most core high return drilling inventory left in the basin. So one broader way to frame that is, based on this data, we have 12% of the remaining sub 50 inventory versus only having about 5% of in-basin production. Now, before I wrap up comments and turn to some questions, I want to illustrate some of the assumptions behind our view that basin egress is very supportive of a constructive forward oil price realization. So on this chart, what we're doing is framing the oil takeaway versus what we see as future oil production in the basin. So as you can see in the chart, historically, the Bakken has dealt with a relatively wide oil price differential, which was initially driven by insufficient pipeline takeaway. That dynamic began to change significantly when DAPL came online in 2017, as you can see on the chart. You know, clearly right there in that early 2017 period, a lot of additional capacity was created by DAPL. And you can see the resultant impact on differentials up above that in those gold bars. Now, since DAPL, you can see that prices improved markedly. The last few years, the oil price realizations have sat there in, call it the $2 to $3 range, outside of what was a bit of an anomalous differential world in 2020. Now, today, we're dealing with an even more constructive outlook, given the significant spare pipeline capacity in the basin. So if you zoom into the chart, you can see the additional approved DAPL capacity that came online in late 2021 and the 400,000 plus spare basin capacity that created. So if you look into the future, you can see how the internal Enerplus volume forecasts look, and those are based on either a 30 or a 50 rig case. And you can see how that also compares with a recent Wood Mac view of forward production. So all of those scenarios paint a fairly clear picture of continued excess egress out of the basin. So based on all of that, we now expect our 2022 realized oil prices to be at par with WTI, and we continue to expect tight pricing between par and -2 over the longer term. So let me just make a few wrap-up comments here. So again, for the Bakken as a play, the Williston Basin as an area of focus, we continue to see that as an attractive oil and gas investment, not only for ourselves, but for investors as well. Specific to Enerplus, we have a very high quality 10-year plus runway of inventory that's going to continue to drive volume growth and, more importantly, cash flow growth. We have an operational mode that continues to leverage environmental, safety, and good governance right into our operating model. We're trading at a very attractive free cash flow yield today. We are committed to maintaining low leverage and a strong balance sheet. At the end of the quarter, we were at 0.7x net debt to funds flow. We maintain our commitment to shareholder returns, and we've now deepened that with our recent announcement of returning 50% of free cash flow this year, or a minimum of $350 million to investors via dividends and share buybacks. And we continue to see a long-term view that's supportive of our ability to continue this model. So thanks again for your attention, and happy to take a few questions.
Thanks, Wade. That was a very good summary. If we can start just back to the Bakken and your quality of locations there, how many wells per section have you guys drilled compared to some of the others that blew themselves up in historical times and overcapitalized?
Yeah, good question. The basin has actually saw companies, if you want to be neutral in the comments, companies have tested a lot of things over time. And really, Enerplus's direction was quite different than many peers. It started out at lower spacing and now has gotten to a spot where in Fort Berthold, we're very comfortable with our spacing model. Whereas other companies may have tested the upper bounds and really, in some cases, clearly overcapitalized some units. So in the core of the play, we actually see the ideal spacing model to be approximately 10 wells per unit. In the core of the play, both the Bakken and the Three Forks work. So we typically are seeing 6 Middle Bakken wells and 4 Three Forks wells as kind of the standard template. Now, as we go forward, we custom design every unit based on offsets, et cetera, but that would be our standard. We think that development model applies as you move into northern Dunn County. In fact, we see that area as being very comparable in quality to the legacy assets we've had in Fort Berthold. When you get beyond that, in our portfolio, we're mostly looking at developing the Middle Bakken, and there that spacing model would range generally 5 to 6 Middle Bakken wells per unit. But I think one of the exciting things for us is we're going to continue to see where we can extend Three Forks development, particularly in Dunn County.
Okay, so you've got a lot to do. And do your completion techniques vary from area to area, or have you been do you think you've pretty much standardized them?
Well, again, prior to the 2 transformative acquisitions we made last year, we had gotten into a fairly repeatable cadence. If you looked at our well performance in the core of the play, the well performance literally was tracking on top of itself year over year, despite the fact that we were becoming more and more weighted to development wells and infill wells. So, relative to a lot of plays, it's a good track record of consistent well performance. In that, the completion design evolved, but I would say the last couple of years had stayed pretty steady in our recipe.
Mm-hmm.
Now, as we think about the new areas we've acquired, there clearly is a case for differentiating that stimulation design. For instance, in Williams County, if you just look at the historical designs. It looks a little bit different than what we've been doing in Fort Berthold. And so we actually see a need to continue to test that to find not only the ideal completion design, but we'll also be doing some work to find the ideal infill density as well. And then when you move into Dunn County, there, what's interesting to that position we picked up was we literally had not saw a new completion on the acreage we bought for 5 to 6 years. And so kind of the completion design and even the well performance on the units we bought is helpful, but it's not really relevant to today's stimulation design. Now,
It'd
fortunately,
be pretty dated, right?
it would.
Yeah.
And we
Yeah.
we knew that and we factored that in as we evaluated that, tried to predict future well performance. Fortunately, in a lot of that northern Dunn County area, there's been fairly significant industry activity from some of the biggest operators in the basin. And so we have a lot of adjacent and relevant analogs of both infill density design, completion design, and well performance from those operators. And so that also gave us a lot of confidence that the acreage we were buying had a lot of upside potential beyond what it had demonstrated. I think in northern Dunn County, you'll see for us probably a similar completion design, but as you move further south, and we have an area in southwest Dunn County we call Murphy Creek that we're actually quite keen to apply modern stimulation practices to. There just hasn't been a lot of activity there. So we'll test a few different things as we develop some of the new acreage we have.
And we'll start to see that this year, or
A little bit this year, and then a
Yeah.
lot next year. One of the pads we're bringing on this year came from our Bruin acquisition, but that's in the core of the play.
Yeah.
We are beginning to drill wells in that Dunn County area, and so you'll see wells come online from that, certainly at least by next year.
That's super. Now, to bring up a bad topic, I mean, DAPL, any chatter again that they're thinking of shutting it down? I haven't heard anything in the last year, but
we have not, relative to the types of questions we were getting last year, or even what was going on externally. It's very quiet today. There's a couple of very positive signs. One is middle of last year, DAPL actually expanded by 180,000 barrels a day. So that was approved and it expanded and it's now operational. Of course, the pipe has continued to be fully operational during this whole period. So, there still remains one last milestone, and that full EIS is currently still in progress. I think right now we're expecting the output of that in the fall of this year. But our view is that the risk that we were carrying before, or that even the industry was carrying before, is significantly less than it was. Frankly, would see it as a very surprising thing for anything to negatively come out of that review.
that's good. I couldn't believe when they thought they were going to drain it all. The stupidest shit's going on. These people. On the A&D side, I mean, obviously you've done your 2 acquisitions last year. You have your Canadian assets up for sale. With the volatility in oil and gas prices, has it been tough to kind of strike a deal on those? And also, what do you see on the acquisition side in the Bakken, if anything?
Yeah, maybe let me make a few high-level comments and I'll try to answer your specific questions. The A&D markets today are very different than they were coming into last year when we struck those 2 deals. And clearly now the timing of those 2 deals was ideal. And we had a sense for that. I mean, we had kept our balance sheet in great shape, and we were in a spot to be opportunistic when the market began to turn. And so clearly when we did the 2 deals last year, it felt a bit like a buyer's market. Not that it was low risk or no risk, but those we were quite pleased to find those opportunities and add them to the portfolio. And as last year progressed, and as we come into this year, we're just in a very different market. I think today, if you are going to be a buyer in the market, so to your question of of further A&D or acquisition work by us in the Bakken, we continue to look at almost every deal that is available, and even ones that aren't available. But today I think you have to be a very careful buyer. When oil's at or above $100 and you've got some of the volatility out there, we are very focused on value. And so, despite our equity, recovering considerably over the last year, we still see a very compelling value in buying our own shares. And so any kind of opportunity for us to acquire more Bakken inventory or volumes has to be weighed against that kind of opportunity in our own shares, and obviously a company we know really well. On the flip side, you mentioned that we do have our Canadian assets actively in the market. That process is on track, proceeding as we would have thought, and we generally would still expect updates in the summer for the market. Given the constructive market, we're actually, we would generally be pleased to sell in to today's market. With that said, we're going to be quite disciplined about value, though. These assets that we have in Canada, or even our other non-core assets in Pennsylvania and the Marcellus, at today's prices are generating significant free cash flow. And
you love that gas in the Marcellus. It's only non-op 10%. Yeah,
that's fantastic.
Yeah.
Yes. And so, for us to be a seller of any of those assets, specifically the ones we have in the market in Canada, we're going to need to see good, strong, fair value, because our alternative is we simply continue to operate those and clip a really nice coupon.
Oh, for sure. We're running out of time. I have more questions. Maybe I'll have to give you a call after.
Sure.
I don't think there's anything from the audience I missed, but I do have some. I'll give you guys a call maybe tomorrow, and you and Drew, and we can do a few add-on questions if you don't mind.
Happy to.
I really appreciate your time, and it was a great story. So keep doing what you're doing. That's okay. I'm a happy shareholder for sure.
Thank you, Jess.
Thanks. Take care.
Okay, bye.
Bye. And now we have newer to the public markets is ROK Resources. With us today is Bryden Wright, COO, and Jared Lukamowski. Close enough. Who's Senior VP Land and Business Development. ROK trades under the symbol ROK on the Toronto Venture Exchange, and also on the OTC under PTRDF, which is always a mouthful, those OTC symbols. I'm not sure which of you is going to share the screen.
Share the screen, and Bryden can kind of start to walk us through a recent investor deck that we just put on our website. So we'll.
Yeah, you guys just had a budget update since your last webinar you had with us about 3 weeks ago. So if anyone wants a fuller story, they can have a glance at that one.
Yep, absolutely. All right. Well, thanks, Jess. Thanks for including us in this conference. We're a little bit of the new kid on the block, so we want to share our story, share our team, and provide some updates to everybody that's listening. So we come from a private energy background. The three of us three founders, Cam Taylor, our CEO, myself, and Jared, we built and sold 4 companies in Southeast Saskatchewan for over about a 12-year period. The last of which to Torque in 2018. And so we decided in, I guess, late 19, early 20 to go the public route. And that, brings us to where we are today. So the three of us have worked together for, like I said, about 15 years. Cam was the previous CEO of 3 of the 4 companies, and continues in that role as chairman and CEO. And then myself, chief operating officer, and Jared, our senior VP land and BD. So I'll speak quickly on our past transactional history. We built and sold 4 companies in Southeast Saskatchewan, all of which were basically built from the ground up, 0 barrels a day. So built, land acquisitions and by the drill bit for the most part, with a few, key acquisitions here and there. We were able to transact successfully on all 4 of those to Crescent Point, Legacy, and Torque for the last company. And like I said, we then moved into the public space for a number of reasons. Primarily at the time, it was, lack of access to capital, lack of liquidity for shareholders. And, our shareholder base was a pretty tight knit group for the most part. And they were looking for, other options. And that's what brought us to where we are.
If I may, Brad, I'd also add, another reason why we made a decision to go public is there wasn't a lot of consolidation in the space, anywhere from 100 BOEs a day to upwards of 3,000 barrels a day. And we thought we could play a small role in that, providing liquidity to some of the private oil and gas companies where shareholders were feeling a bit of fatigue, and it kind of fit well into our material acquisition that Brad will talk about.
So we began acquiring land and assets just on a very small basis back in 2019, just the 3 of us. And, we were always looking for a high quality set of assets, ideally in Saskatchewan or Alberta. We've been based and out of Regina for our entire careers, I guess, Jared and mine, the last 15 years. And we wanted to, focus on Saskatchewan, but also look elsewhere. And so, what we ended up transacting on, which Jared, you could go to the next slide, was this federated co-op asset base, which we knew very well. We had been partnered on a number of locations in the past with some other companies in the basin, and something that we had coveted for a long time and had a lot of experience with. And so we originally did our first small acquisition back in 2020, the day that oil went negative, and added some smaller pieces over the next year until in March of 2022, we transacted on the federated co-op asset base. And so it was a $72 million deal that we financed with a combination of debt, $65 million facility, as well as an oversubscribed bought deal through Echelon of just over $17 million. The asset base is a combination of Saskatchewan, light oil, solution gas, and then Alberta, the Kaybob asset is about a 50-50 gas to liquid, actually probably 70-30, I guess, gas to liquid ratio, but we do see a lot of upside, which I'll speak to here in the coming slides. So again, prior to the deal, we were growing. We were 200 barrels a day. We were tiny, and we were looking for that transformational acquisition. It came in the form of the FCL assets, where we white mapped them out of all of their upstream production. And what this asset has done to ROK is transform us into a high cash flow company that can pay down our debt in an expedited fashion, and the mechanism, or the debt structure, allows us to do so with no prepayment penalty. So we just did release some guidance. We're looking to drill 10 operated wells in Southeast Saskatchewan this year and exit at 3,500 barrels a day. We're sitting just under 3,000 barrels a day today. And this asset base, because of where we locked in our hedges on the 8th of March, as well as the quality of the oil and gas plays that we have, we're able to generate a significant amount of cash flow, upwards of $67 million annualized for the remainder of 22. And it generates free cash flow even with our aggressive debt repayment structure. The asset itself, again, the base production and really impressive net operating income that it can drive. Really high net back oil, low royalty rate. We're in that around that 13.5% royalty rate across the board corporately. The hedges we did lock in as a covenant of our debt, 75% of our declining PDP over a 24-month period. And it was a very lucky timing. In all honesty, we were able to hedge on the day that oil hit $128 and put ourselves in a really good position over the next 24 months. We have a significant land base, just under 1.4 million gross acres of land, significant amount of upside both in Kaybob as well as Southeast Saskatchewan in terms of drillables. And then, of course, our interest in the Weyburn unit, which everybody on this call likely is very familiar with that unit, and both its just rock solid production and low decline, but also its ESG impact on a company like us. So as far as our current capitalization, we have just under 188 million shares outstanding. With the raise, we did issue a fair number of warrants. That being said, we believe as that capital, as those warrants are exercised in 3 years from now, and we bring in the cash, we think that there's significant torque and upside, even with that dilution as we bring in that cash. On the forecast, again, 3,500 barrel a day exit rate we're forecasting. That's driven by an $18 million capex program, the bulk of which is the 10 well program, as well as some workovers both in Alberta and Saskatchewan. And so, one of the things that we really liked about this asset base was, it was a little bit capitally starved over the last 4 years, and a lot of low-hanging fruit, especially with this commodity price increase, both on the gas and liquids and oil side. And so we have a modest $1.5 million budget on workovers, or rather reactivations and optimizations, and that may be increased as we move forward in the year. But we do believe that there's a lot of upside, both from a drilling standpoint, but also just reactivation, a little bit of infrastructure work in Alberta. And all of that will drive that cash flow over the course of this year, given the strength of our hedges. So this slide, again, because of the the hedge book that we were able to secure, the price of our unhedged volumes doesn't have a material impact on 2022. Obviously, as we add more production and the wedge of production that is hedged declines, that may change, right? But as far as you can see the sensitivities here at $60 oil upwards to strip as of last week, it's only about a $9 or $10 million difference on our NOI. And as well on our free cash flow, we would range from 6 to 15 million of free cash flow, and that's assuming 37.5% amortization on our first year with our debt, as well as additional cash sweeps that we've built into that. So our goal over the next 2 years is to retire this debt, which does not have a prepayment penalty, and so we can our focus is, number one, are to reduce our debt. We are forecasting roughly a 40% debt reduction by January of 23, and then look to retire that debt within a 2-year period. At that point, we envision we'll be in excess of 4,000 barrels a day and cash flowing anywhere from $60 to $80 million a year, and being in a really good position as far as our balance sheet goes. So this slide is a bit of a peer comparison, and as we're small. We're a lot smaller than a lot of our peers, even some of them on the calls today. But I think what we try and highlight to investors and to the market is that our goal is to grow. Our goal is to both grow through the drill bit and through acquisition. And I think there's a lot of torque based on where we're trading today. I think we have the ability with this asset base to achieve a significant amount of cash flow and free cash flow, and that's our goal. Our goal is to retire the debt, increase our free cash flow per share, and begin to pay a yield, incorporate a dividend at some point, and as soon as possible, and begin to pay our shareholders. And we have a strong track record of growing companies by the drill bit, and I think it's going to be a combination of that with really strategic tuck-ins on the acquisition side, and understanding that the M&A market's a little bit more challenging over the past 3 months, 4 months than it was when we did this deal. But I do think that as long as we're prudent with our with our analysis and our, what we're looking to acquire, I think there's an ability to grow with the right assets in addition to what we have today. So our focus of our Southeast Saskatchewan drill program for 2022 will be in the Frobisher formation for the most part. I'm thinking, I think 9 or 10 of the locations are all in the Frobisher. And, I guess anybody that's operated in Southeast knows, the economics that can exist in this formation and why it's such a valuable and sought after play. It's, it's complex geologically, there's risk, but we do believe that we have, a number of lower risk locations that we do plan on drilling in the next, I guess, 2 weeks. We'll probably be kicking off here, 3 weeks. So the economics, as you know, are phenomenal in some of these plays, and we've built this based on our GLJ curve, or rather McDaniel curve, that has been booked on, I'd say 90% of our locations are booked on this curve. There is a tier 1 curve a little bit higher that we don't use in our forecasting as well. But, we're excited to get out and drill and show what this asset base has to offer. There's a subset of the land that we owned in previous ROK, where we are drilling 3 of the 10 wells on, and then the remaining 7 are on the Federated Co-op land base. So in Kaybob, this is a big growth area that ROK will undertake in late 22, early 23. We have, it's a stacked reservoir with about 8 or 9 zones of interest, and we have rights in all of them, at least on the bulk of our land base here. And what I'm showing you here is the Cardium, in which we have about, I think there's 12 book locations, and we see upside of another 10 to 15 potential locations here as well. And the economics on the Cardium start to get really interesting at that $80 mark for us. And I think there's some ability to really, I think, grow a reserve base out here. I believe it's fairly conservatively booked. And there's a lot of players that are starting to get active in both the Cardium, but also in the Montney now with gas prices, the Dunvegan, the Blue Sky, and we have rights in a lot of these formations on a variety of areas. And so, we're going to kick off a workover program in this area this summer, and a reactivation program. And then our drill program will start in early 23. And so we're just working through that today, but it's a, phenomenally exciting area. And, the Montney is a completely unbooked zone for us in our reserve report. So we believe that there's a lot of ability to grow reserves on the gas side. And again, we're going to look to deploy capital here in 2023. So we did an update on our reserves as of April 1, and we did that with McDaniel. It's when we did the deal, it was $72 million acquisition. PDP was about 96 million. That's now increased to 114 million. And the one thing about our reserve report, I historically Federated wasn't very aggressive on bookings, and I believe that we kept that consistent. And our goal is to grow this reserve base over the course of this year and exit, with some attractive increases. And so I do think that there's a lot of room for growth, both from a reserve standpoint, but also from a drilling location basis as well. So, as far as catalysts for growth, one of the bigger things that we've been working on as a management team is getting our name out there and our faces and our story, understanding that we're at the early stage of ROK and our growth is just beginning. So in April, we released the updated reserves report. Recently, we announced our budget for 2022, where we'll kick off our program, which again is a 10-well program plus about a 10 or 12 well workover reactivations in Saskatchewan, plus an additional 3 to 4 wells in Alberta, and then the actual drill program up in Kaybob in 23. And so, why do we believe that we're, a company that can that can grow this, the reserve base and actually provide return to shareholders. I think, again, it's our track record and our ability to build and sell companies, but also just the ability to grow companies from, a stable base into something a lot larger. And this asset base has provided us that platform to grow from. And again, we have 3 to 4 potential bolt-ons that we are in various stages of evaluating. We're aggressively going to pay down the debt and improve our balance sheet. And we're excited to get moving and continue to engage with the market.
Well, thanks for that. That was a very good update and fast. So just a few questions for you guys. With your workover program, you're spending 1.5 million on, how much production do you think you can add?
So we're adding roughly about 1 million a day of gas is our expectation, plus an additional 150 barrels a day or so of oil. So, what does that take us to? Give or take 300 barrels a day. That's our goal to bring on. And that's a combination of Alberta, Kaybob area, as well as some Southeast Saskatchewan workovers.
Like you said, there hasn't been capital really deployed on these assets since 2016, since they've been for sale. So you must see there's more low-hanging fruit than what you're saying as far as that amount of workovers. Yeah,
so we're in the early stages. Like I would say specifically in Alberta, that's right, Jess. It's I'm in Calgary right now, meeting with the team and just working through a number of these locations that have just been capitally starved, and there hasn't been any capital deployed. And obviously part of that is gas prices over the last 8 years. And so yeah, to answer your question, that's not the maximum that we have to do work on, or as far as workovers and reactivations go. There's probably another 20 locations that we're doing a lot of work on here. So I think that's just the beginning of that program. And again, because of the amount of zones that we can target that look really attractive at both oil and gas prices right now, I think you'll see a lot more work from us and hopefully some positive news over the next 12 months. Perfect. Thank you. So after this program that you're starting in June, first of all, are any of these locations ones that could be considered, new pool or pool extension opportunities? Yeah, one in particular, we're drilling a bit of I wouldn't say exploratory well, but it's a new pool potential discovery in Saskatchewan. And so, it's a vertical that could end up, upon success, resulting in an additional 10 to 15, locations. And, if that's something that is completely unbooked, something that would provide significant, cash flow at this price. The Frobisher play, and as you saw on the slides, the economics are really, really solid at this price. And so, that's an area that we're extremely excited about, and one of our first wells we're going to drill. And then there's a couple others, probably 2 other locations that have been, again, just very conservatively booked that we could, let's say there's one location booked in one of our core areas, and we believe there's upwards of 7 or 8 drillables there. So we're drilling some lower risk step outs, but at the same time there's room for reserve growth on a number of these locations, and that's part of our strategy. Okay. So while you're paying down debt, you're improving NAV by adding to your reserves production and paying down debt aggressively. So that is a good combo. With your debt repayment, how much, like you say, you're aggressively trying to pay that down within 2 years. Zero debt's obviously not an efficient use of capital either. What would be your ideal ratio? Yeah, I think we want to target about 0.5 debt to cash flow ratio. I think you're right. I don't think having no debt on the balance sheet is an effective way to run the company. And so, if we were to, eliminate that debt, or, I think a real option that we'll consider is a recap of that debt, and bring in some more conventional debt. And of course, with that is our ability to grow and look at other acquisitions and kind of consolidate that into a one transactional item. But yeah, I agree. It's we'll always probably carry a little bit of debt on the balance sheet, but our 0.5 or less is kind of our comfort zone.
Okay. And is there any opportunity to maybe, it's somewhat expensive debt given the inability to get RBLs from banks if you're under a certain size. As you grow a little bit here, do you think there's a chance to bring, to either term that out or find an alternative source?
There is, and we're having those conversations today. We've met with a few groups about that option, and I think, to your point, conventional debt under 10,000 barrels a day is a real challenge. That may change over the next year. Maybe banks will be a little bit more aggressively, looking at these opportunities, because I do think, there's a lot of, given where you can lock in hedges, there's a lot of options there's a lot of opportunity rather for financial institutions to create some relationships with companies like us. But yeah, we are going to aggressively look at that, the refinance option, and it may come, like I said, with other transactions, or when we get to early 23 and we're sitting with, say, sub 30 million of debt, we may have that option to do that at that point.
Okay. And you mentioned you're looking at numerous acquisitions at this time. Like they wouldn't be huge, I would suspect, but there's probably a lot of private or mom and pops or PEs, private companies that would be looking to transact, or would they be willing to take your stock?
So there are certain parties that are, absolutely, and those are the ones that we've been having conversations with. I think given our ability to grow and kind of where our stock is trading today, I believe that there's a fairly big interest from these groups to take paper of ROK, and we're open to that at the right price, and assuming that the metrics are accretive to ROK. And again, it's about growing the free cash flow per share, and that's really what we're focused on. So I think we'll look at a combination of debt and equity in the right scenario. And but it is tougher, and I believe the previous presenter said the same thing about acquiring in this price world, in this $100 plus. It's a bit more challenging, and I think the buyers are looking to buy at $80, or a deck that's a little bit lower, and sellers want 105, 110. So
yeah, then the price keeps changing, so then every day as well, so It becomes very difficult to get a deal done.
Exactly.
Yeah. So on the back of that, you guys have grown your other companies, right, from like buying the land, running running seismic to drilling. So right from inception, now you're starting with a good base of production. Do you feel comfortable growing this to a larger size? And with your current staff, how big do you think you could get comfortably without having to add a bunch of people?
Yeah, we do. And I think looking back at our previous companies in the private space, we never had a mandate to grow to 2,000 barrels a day and sell. It was always let's build a company, get it into a position that makes sense, see what the market looks like from an M&A standpoint. And it always just seemed to be that 2 to 3 year time frame where we'd always be in between 2,000 and 3,000 barrels a day.
And someone would want you. And
exactly. The opportunity was there, and that's what the market was doing. There was always those mid cap companies that were looking to gobble up these small privates. But as far as the goal of our management team and the plan for this company, it is to get larger. We'd like to be 5 to 10,000 barrels a day 2 years out from now. I think there's a reality with this asset base to if gas prices remain strong to grow this to 5,000 barrels a day as it sits today. and then, through acquisition, try and add a couple thousand barrels a day. So as far as the comfort level and the ability of our staff, we have a very strong staff in Calgary that we were able to acquire from FCL. And in addition to our core staff in Regina and Southeast, obviously from a field perspective, we'd be adding bodies and adding the right people if we did acquisitions. But I think from a internal team and management group, I believe we're capable and very interested in running a larger company.
Okay, awesome. And if there was one key takeaway, being you're new to the public markets, what should investors be focused on, and where do you think your forte is?
Yeah, good question. I think our forte for sure is growing, growing by the drill bit, operationally strong. I think we know how to position companies to sell. But that being said, I think we want to provide, full transparency to shareholders and let them know that our plan is to grow, provide at some point, provide a dividend, start paying them back. And really it's we're a hungry team, we're a young team for the most part, and we're a team that hopefully is going to be around a long time. And, that's really the one thing I want the market to know is that we are kind of in the earlier stage of the public space, and we're really enjoying it, and our plan is to grow and be around for a while. So
I want to take a second and brag about the technical team a bit, which includes Bryden. But everything we did in the private space, our technical team went from 0 to 2,000 barrels a day, and having access to 1.4 million gross acres of land. I think we're really excited about where we can take this prospect and the potential of other opportunities as well. So, I think that our company's strengths is on the technical side, without question. And this asset, again, provides that framework for us to be able to grow. So I think that's where our excitement is today.
And you guys are very old, so it's you have to do something for another 30 years, I would hope.
We have lots of kids, so
20 years, yeah. 20.
And there are not many new teams out there, so it's great to see. And so congratulations on your acquisition, and we look forward to hearing more from your success from your drilling program.
Thank you, Jeff.
Okay, thanks. Okay, talk soon. Okay. Yeah. And next up, we would have Canoe Energy. Dale Schwed is on, I think. Dale?
Yeah. John and I are in the room.
Hi, guys.
Oh, how you doing?
Not bad. How are you doing?
Doing well. So we're going from the young to the old, are we? Is that right?
The good thing is you don't look any older than them. With the camera this far away.
Yeah, that's a good thing.
And what's exciting is that Station 2 gas is in net zero.
Exactly. Yeah. Pretty happy about that.
Yeah, congratulations on a great quarter. So we've got Canoe Energy here, John Leach, CFO, and Dale Schwed, President and CEO. They traded under the ticker symbol CR on the Toronto Stock Exchange and OTC CWEGF. I don't know how people memorize those. But anyway, so if you want to touch on your quarterly success that you had drilling and what we'll start there, and then I have some questions for you.
Okay, awesome. So Jessica, how many minutes would you like us to go through this?
Yeah, so we don't have a whole hour for you. So why don't you spend about 25 minutes and then I'll ask about 5 minutes of questions. Does that work?
Yeah, that works great. Thank you.
Okay,
so there are advisories on page 36 of the presentation if anyone wants to go to that before we start, but I'll just start in here just about Canoe itself. Really, we started the company coming out of Baytex in 2003, and we named it for our team that our goal is to work together, obviously, to get to a common goal amongst us all in terms of growing our production base. So that's really what we're doing. You take a look at our growth up 20% this year, 80% in funds flow. I won't spend a lot of time on this slide, but there's a lot of points here I'd like to make, and we'll make in more detail and through the course of the presentation. I think the big thing here is that we did form a plan back in the middle of the pandemic in the summer of 2020 and looked at forward gas prices. And we just experienced 6 years of gas prices averaging around $2 an MCF. So when we saw pricing in the $3, $3.50 range, we're pretty excited about that in 2021 and into 2022. And we formulated this plan to really increase our margins by filling our facilities, our transportation commitments. So that, and that's where we are in the second year of that plan. And we've been very successful doing that. And we'll get into how we've done it and where we're going to go from here. The big thing for us in the last little while is liquids. We put a lot of liquids on production through our UCR area, or where we have a lot of condensate, as well as I think the share price is really well supported by a value proposition. Our 2P reserves at the end of last year was 1165 on the 2P basis. So, and that was using very low commodity prices. We have ample capacity to go to 40,000 BOEs. We have one of the biggest land bases in Northeast British Columbia at 260,000 plus acres. Our liquidity profile here is excellent. We just increased our bank line to 185. Don't plan on using it, but would like to have that kind of liquidity available to us. We are dedicated shareholders and bondholders. 6 of the top 10 shareholders are insiders, and we have plenty of tax pools to take us into probably past 2025 with $1.2 billion of tax pools. And there's a snapshot of our capital structure. On next page, just you asked about the Q1. These are the highlights of Q1. Our production was up 27% from last year, same period, to 33,400 BOEs. Op costs were down quite nicely by 25%, and that was one of our goals, as I stated earlier, to decrease our cost structure down to 350. AFF or cash flow is about $78 million or 48 cents a share. It's a big increase of 129% from the prior year. And our free cash flow was about $22.3 million. The CapEx through the quarter is about $55 million, and we completed 6 wells and drilled 5. And you can see the graph on the bottom here. And funds flow is up quite nicely quarter over quarter and has been going up since. And we would expect Q2 to be better than Q1 based off of pricing. And you can see our costs coming down with time. On the next page, just take a quick look at the fundamentals of gas. I probably don't need to go into this a whole bunch, but we're very bullish on gas in the future. And you can see really on the far right, even renewables have a steady incline, but not to the same extent in the growth of natural gas or petroleum and other liquids. And that's an IEA study. So very bullish on hydrocarbons going forward in terms of providing the world with its energy needs. And I think we've seen indications of what's going on all over the world, more recently, specifically around shortages in Europe and elsewhere, and obviously the unfortunate war between the Ukraine and Russia. And on the bottom right, really, we are into another super trend, as you can see here. Usually these things last about 10 years, and we're just coming out of a down cycle and hopefully into a nice upcycle for energy, which is clearly supported by the fundamentals, as I just stated. So let's take a look at our growth plan, and I'll flip through these fairly quickly. When we started the plan, we were in 2020, we averaged around 22,000 BOEs a day. Last year, we averaged 26,400. This year will be between 31 and 33,000. In Q1 of this last year, or this year, we were at 33.4 thousand BOEs. And really, that's the goal here, is to get to that 31 to 33 this year. And then over the next few years, fill our capacity up to that 40,000 BOEs, as I stated. This is what we also stated in that plan. We want to reduce our cash costs by around 25%. There's the components: operating costs down about 30%, transportation 25%, G&A 10%, and interest by 30%. And you can see in Q1 we hit that goal at $9.61, which is in the midpoint of our $9 to $10 range that we estimated 2 years ago. And next on our AFF, lots of changes here, specifically around where commodity prices are, much better than what we had projected. We're going to be in that sort of $245 to $265 million this year, and that's using fairly conservative prices at $85 WTI. and $5 NYMEX gas prices. So we think there's room for upside in those numbers. And even with those numbers, it should throw off around 150 to $185 million of free cash flow. And our uses for that free cash flow would be to reduce our debt. We want to pay down our bank line to zero, and then apply the rest of the funds to reducing further debt or growing the production base. So this is leverage metrics again from a DOE perspective, nicely down to 11,700 in this quarter, and from a debt to EBITDA basis, last 12 months, we're ahead of target right now. In Q1, we're 2 times, and by year end, we plan on being around 1 times, as you can see here. So definitely, deleveraging is the plan, and we continue to focus on that. And this is next page is really just a synopsis of what you just saw over the last 2 years, from 20 to 21 and 20 to 22. I think the big changes here, and what we're very happy about, is the production per share growth every year is around 20%. And the costs are coming down to the extent this year by about 21%, even though we are seeing inflationary costs in the industry. Our costs are coming down. Cash flow is up quite significantly this year, up about 92% from what we did last year, and so is the AFF per share, up about 88%. So very happy with what we're doing from a debt deleveraging perspective, growing the production base as well, and increasing cash flows. Let's take a look at the Montney resource itself. Here's a map of most of the shale basins in North America. One thing I will say about the Montney, it's not a shale. It's more of a siltstone sandstone sequence. As a result of that, it can store quite a bit more hydrocarbons than a shale, and it does act more like a tight conventional reservoir. So the declines that we have in our more mature production is around 11%. So very easy to replace that, clearly. So once you've got a lot of your production on and those facilities filled, it doesn't take much to keep those facilities full, and that's kind of the general rule with the plant. In terms of the inventory, you can see there's a number of different thicknesses of the Montney on our land base. You can go anywhere from 500 to 600 feet to over 1,000 feet in thickness. We have up to 5 different zones that we plan on developing, and you can see that we mostly developed the land around West Septimus and Septimus, with 109 and 87 wells drilled in those 2 areas. And really, it's only because that's where our facilities and infrastructure is currently located. So what we try to do is optimize all of that in those areas. But we're very, very enthused about some of the upside that we have at Attachie, at Groundbirch, as well as West Portage and Tower. And you can see the number of locations on the bottom there that we have in each of those areas. On the next page, this is a new slide in the presentation, really illustrating our land base in a different perspective, as well as our land, the well control that we have on our land. And obviously, we're very well connected here with the 3 pipelines, the TransCanada system, the Alliance system, and the Enbridge system. We're connected to all 3 of those systems. We're also literally a stone's throw away from the connection at the TC meter station that's going to take gas to the Coastal GasLink pipeline, which is going to take them to LNG Canada. So we're very well positioned from a land perspective, as well as a pipeline perspective, to connect into that as to be a potential source for gas for any of the proponents that are in that project. This is more recently, this is some of the things we've been doing operationally. You can see here, this is at the Greater Septimus area. There's a well log on the right. You can see we've just recently completed the 414 pad. That's 10 wells, 421 pad, 5 wells. These wells now are paying out in under 6 months. Newer wells are, just because of the condensate content we've got in them. In addition, some of the older wells that we've had in here are paid out in 300 plus days, 330 days. Some are paid out in just over 200 days. So very happy with our capital allocation in this area, and very excited about some of the results that we've had with those recent wells, illustrating much higher condensate rates that we can now take and drill further east. And I will remind the viewers that we do have quite a bit of land east of where we've cut this map off, so we can continue to go in that direction. Next page, just illustrating how good those wells are. On the left, that's the 414 pad. That's 3 wells to the east. We have the most production on. Right now, after 75 days, you can see here they've been on averaging about 2,100 BOEs a day, 600 barrels a day condensate, and 8.4 million a day gas. On the right, these wells, by the way, were about 4,140 meters average lateral length, so quite long. And then the ones on the right were about 2,700 meters, and that's average 110 days on now there, 16 BOE a day, and you can see the 5.8 million a day gas and the 282 barrels of condensate average in those. So very robust, and more importantly, what we have booked in our reserve report is the dotted line that you see below the actual production. So quite a bit ahead of the type curve that was booked. So happy about that as well. The next page, this is an area that we've been recently more active in. This is called Ground Birch, and we actually drilled the 3 wells there that you see on the map to hold land. We actually held around 55 sections of land with the drilling of those wells. When we drilled the pilot well, we were very excited about what we saw in the logs. We decided to drill the 3 wells off to the west. On the right, you can see the productivity of those wells averaging right now IP 180, about 8.6 million cubic feet a day. And again, there's the type curve that we have in the area. So it's far exceeding what we have booked. And what we like to see is that flattening out of that production curve as we continue on in the production lives, which is what we're seeing here, which is in our view, very positive. So what we're doing now is we have 5 wells from that pad that we've drilled to the west, and those wells are planned to be completed in July and then put on production. We have plenty of pipeline capacity in here to take this gas to our Septimus gas plant and also to our West Septimus gas plant, so we can split the flows to either plant. In the future, we do have plans to build a plant in this area at Ground Birch. We have a lot of land, 70,000 acres of land. You can see by the big yellow block there that there's a lot of drilling to do on that land. And draw your attention to that one pad down to the south that's about a mile off our land. As we go south, those 2 A wells, the double A wells, which we feel are probably the most prospective zones in the area. But we are drilling 3 other zones in these other wells to delineate future development in the area. Those wells have been on for about 6 months now at an average of 12 million cubic feet a day. So very robust production from those wells. Just draw your attention, this updated this slide. I think it's quite interesting, the fact that I alluded to earlier, we had 6 years of $2 gas, and that's illustrated on the left by the blue line. That's AECO pricing, and we did take some of our gas to Chicago, so we had a better price in the pink that you can see there. Updated it to Q1 22, and you can see just in Q1 that we've cash flowed. We spent more money there as we should have, but as we put those UCR wells on production, and I think Q2 will be a telltale, and we'll have a lot less capital spent there and much more cash flow. Nevertheless, what this shows you is that when commodity does not support development, we don't spend it in these areas. And so what we did is we took cash flow, you can see in 2016 to 20 out of that area and deployed it into the West Septimus area where there were more liquids. And you can see on the far right now that we are 42,000 million cubic feet a day just in the first quarter, how we've ramped that production up very quickly once we had price signals to do so. And we will continue to do that up to where it's got the capacity is around 60 million cubic feet a day. Next slide, just a very quick snapshot of our hedging. We're just around 45 to 50% hedged this year. Falls off to much less than that. Next year we're around 22,000 GJs hedged for next year at the moment. Condensate there, we don't really hedge much going forward. The strip only supports roughly 6 months of that type of hedging, and so we have a lot exposed to the current market, which it has been very robust, and we still have quite a bit exposed to the different markets that you see here. The Station 2 floating, ATP, which is on the Alliance pipeline, some Dawn floating, and also some Chicago floating as well. I will draw your attention also to the fact that our gas, because we have a lot of liquids in it, is very hot, and it sells at a premium to benchmark pricing. We get about a 22% premium to whatever posted price you'll see on a daily basis. On a value proposition, you can see here, there's a lot of numbers on here, but I will say one thing to you, and probably most important is if you look to the graph on the right, which was the commodity prices used in our price deck when we had these reserves run by our engineers. The lower pink line that was used in the engineering report, which is the dotted line, is now about over $5. So it's a $2 improvement for 2023 on gas prices on the strip, and we're over $1 improvement in 2024. So whatever you see here for an NPV has been increased quite significantly since these numbers were done. Nevertheless, we still have about $11.65 2P number for our reserves. That does not include any land value. As everyone's aware, Montney land typically sells for that sort of $1,000 to over $5,000 an acre, and I would say a lot of ours is in the higher end in terms of what we've been able to prove up, specifically around Groundbridge. So I think there's a lot of value to backstop the share price of the company here. This is on page 24, just looking at history, and what we're doing here is reducing our costs, and that's really a function of one thing. Most importantly is we're drilling 2-mile laterals now versus 1-mile laterals, so we're getting much bigger bang for our dollar when we spend it, and as a result, the costs are coming down. And on the right, you can see, importantly, our reserve life index on a 1P basis is 18 years, on a PDP basis is 7 years, and on 2P is 35 years. So lots of running room on the existing reserves we have booked. And if you look at the next page, these are the reserves we have booked on our land base. And I will remind you that a lot of those lines that you see are only one zone developments. So there's a number of different zones that we can develop either above and below what has already been booked. So you can see there's a lot of yellow land there left to be unbooked. As a matter of fact, we only have 19% of our land that's currently booked. And that includes, if we were to develop one zone, that's included in that number that has been booked already. So lots left. And then, we have had a history of buying assets and selling assets when we felt that we could deploy capital in better environments. And that's exactly what we've done. We've now sold over $725 million of assets over the course of time, redeployed it, very happy with our position in the Montney. We don't need to be buying anything in the Montney, as I just illustrated, that we have a massive land base there, infrastructure to support growth as well. So we do have an option, continue to have an option to sell another 22% interest in our gas, or sorry, another 11.4% interest in our gas plant at West Septimus Septimus for $37.5 million. And that comes due in June of 2023. Lots of liquidity, as I pointed out in the first slide. On an ESG basis, very happy where we started and where we're going. You can see here, we have been rising to the challenge of reducing greenhouse gas emissions. And you can see we're down 50% from 2020 to where we're projecting to be in 2022. And you can see our peers in our peer group, we're now the 4th lowest intensity out of the group. So again, this is something that we're focused on and we'll continue to focus on. As well, from other parts of the ESG spectrum, you can see we're 57% down on water, freshwater usage, 76% down on gas plant flaring, and reportable spills are down by 73%. One of the things we're very, very proud of, we're the first company in Canada to bring this technology into Canada. We got it founded out of Germany. It's basically a Kevlar pipeline, and it's spoolable that we can transfer water from sea rings or other places on surface for completion operations. And just in one operation at our 332 pad that we used it on, we took off the equivalent of 7,300 two-way trucks from hauling that water from one location to another, which was the equivalent of about 146,000 kilometers, or 4 times the circumference of the globe in truck traffic, which related to about 329 tons of CO2 equivalent. But that's just the beginning in terms of what this does for us. One of the biggest things in our business around safety, and that's something that we really focus on as a company, and I believe as an industry we do it as well, but this is very important to crew. And what this has allowed us to do is take trucks off the road, and most of the accidents that happen in the oil industry are traffic accidents for the most part. So it allowed us to reduce that quite significantly. Obviously, if you don't have 7,300 trucks on the road, you're gonna have a lot less chance for either spills and or people getting hurt. One of the things we are also focused on is governance, and we have 6 board members, of which 2 are, and I'm obviously one of them who is in management. So we have 40% outside management of our board that are female, represented by females. Then the last page, again, just a summary from what I talked about initially, and with that, we can easily take some questions.
You were so fast, Dale. You were so fast. Just one sec.
How much time did I take? I don't even know. 15 minutes. Wow.
I've never heard you go that fast before. Anyway,
Well, is there any questions? Happy to answer.
I have a few. I hope I can fill 15 minutes worth.
Sure.
Go just, I think it's on your first or second page, just the sensitivity you have to gas. And at least it wasn't your last presentation, sensitivity gas prices for every 10-cent change. Do you have that handy?
Yeah, it's on page 34 of the
Okay.
presentation.
Oh, are you talking that, or
You're talking-
this slide here, I think is what she's referring to,
Okay.
this one.
That one?
With the, is that what you're looking at, Jeff?
Yeah, that's the one I'm looking at.
Okay.
Yeah.
Yeah.
Yeah. So, okay. That's, you know, certainly, I mean, with your low CapEx and, you know, with the amount of free cash flow you have and potentially even more free cash flow, given what's happening in the natural gas market. Do you see a bump in CapEx coming?
Well, you know, I think as I pointed out to you, our number one priority is to pay down our debt. And and I think once we have, you know, very clear visibility to getting where we want to be. And I think overall, this year, our goal was to pay off our bank debt, which was, I think at the end of this last quarter was about $93 million. That's including working capital. So if we can pay that off, we would look at reducing debt a little bit more than that. Obviously, we have to refi our bonds between now and in March of 24, and we'd probably like to do that in the next year. So that's something else we're looking at. But if we continue to pay that down, we'll probably look at refining a lower number in terms of the 300 million that we currently have outstanding. So we'd like to pay down our debt more than the bank debt that we currently have, and then at the same time also look at increasing our CapEx to obviously get to our 40,000 BOEs that we have capacity for. But as to the timing of that, it's going to be 100% dependent on where the cash was coming from.
Okay. Now on that 40,000 BOE a day facility, how much more should your net backs increase given a static gas price?
Yeah, so our fixed costs are around $1 to $1.50 BOE. So that would give you an indication is if we increase the production from where we are, what the potential upside could be. But it would be fairly significant.
So obviously it would be nice to get to that 40 sooner rather than later if you could.
It would.
Yeah. Hedging wise, you already touched on that. Now with this, I mean, do you find that with the success you've had with the UCR wells and now what you've had at Grand Birch, you're seeing new interest from investors? Like, I don't think a lot of people grasp how big your land position is and how prospective it is, and that you've proved up quite a bit, but there's still a lot more to prove up. So are you getting a lot more interest and people as you're having these great wells?
You know, I would say that we haven't. It's kind of funny, you know, when we released our quarter, it was the best quarter we've ever had. Highest production, highest cash flow. Our share price was down 13% on the back of it. So I'm not, you know, we can't. I don't know, you know, in terms of what the investor base is looking at. I think, you know, what we're trying to do is just look at the basics of the company and take care of the things we say we're going to do, which is obviously the 2-year plan that we're obviously engaged in and really ahead of schedule on the plan. And then keep with the plan going to the 40,000 BOEs. So we're just focused on that. And I think eventually, we'll get recognized for some of the execution that we're been successful on.
Well, knowing you guys as long as I have, I mean, this is the best asset base you've had in the 20 plus years I've known you. I think even going like better than the Baytex days for sure. And it seems strange that you're not getting as much traction as I think you should as other players in the area. I guess if you keep putting up the numbers, it'll just take care of itself.
I don't think it's just a crew thing at all. I think it's more an industry issue, just with attracting new investors, and obviously, the ESG influence on investing has impacted, I think, the level of interest in the industry. Having said that, I also believe from a macro perspective that the world is starting to see the importance of what we do and the security that we supply the world in terms of being able to use energy. I think once that sort of hits home, there likely will be more interest in it, and they'll be looking for out of the groups or greener companies. And we showed you a slide there that we're the number 4 on that list in terms of emissions. So we hope to hopefully rise closer to the top. Obviously, when you look at things from that perspective, but like I said, the thing is for us, we just have to continue to execute, and usually good things happen when you do that.
Yeah, I think you're right. I wasn't meaning to necessarily single out you, but I just look at all your opportunities, but you're right. The whole sector is trading at multiples we've never seen before, given where commodity prices are. And what we're going through as far as the overall market, it reminds me a lot of what happened when the tech bubble burst, and then we headed into a huge commodity run for a number of years afterwards. But that said, the money, I think there's money starting to flow out of ESG funds, et cetera. But again, we still don't have that same investor base that would go to resources naturally. What do you think from the audience? In your opinion, what's the best hedging strategy for Crew given its opportunity strengths and ongoing debt reduction?
Yeah. So what we try to do is we try to hedge about 40% of our production going into the forward year. And we try to do that by about 10% each quarter. And that's been fairly prescribed. And we've been doing that for a number of years now. So there's no magic to it. It's more prescribed. It's more formulaic. And obviously you're going to have some years you're going to hedge in gains, and some years you're going to hedge in losses. And I can tell you right now, we've had a lot of hedging losses from our hedge book that we did back in August of 2020. So, but you have to be disciplined. And I think one of the biggest things that we see is that if we have a capital program, and you know how quickly things can change in this business, is we have a capital program that we're going to say we're going to spend X number of millions of dollars. We want to make sure we get a good return on that investment. So as a result, we would probably hedge whatever volumes we have coming on when those wells come on to ensure that we get that rate of return. And that's what we've been doing. And that's what we did with this program. And it's worked. Yes, we have left some money on the table on the hedging front, but we've also protected the company as well and our investment in specific projects. So that's really the philosophy around it.
Okay, perfect. Thank you. I have some other questions, but I'll give you guys a call later if that's okay with you.
Sure.
Yeah, because we have now run out of time, which I can't believe. I know. I can't
How would you start it?
I know. I'll give you guys a call later on if that works for you.
Sure.
You bet.
Okay, thanks so much.
Thanks for the invitation, everybody in Adelaide. Appreciate it.
Okay, we really appreciate you taking the time.
Yeah. Take care.
Thank you.
Thanks. Next up, we have Jonathan Wright from NuVista Energy. NuVista trades under the ticker symbol NVA on the TSX, and he is president and CEO. Hi, Jonathan. How are you?
I'm doing great. How are you doing?
Not too bad. Not too bad. I mean, great quarter for you guys too. I can say that to pretty much everyone that we've had so far.
Thank you. Yeah,
And-
we're super excited. It's great to see the results rolling in and just showing the strength of the assets.
A lot's changed in 2 years. When I came into your office and your stock was 70 cents and Paramount had just taken a position.
I know it's crazy, but I can assure you it bears no resemblance to the value of the underlying assets. As we're now
No.
seeing finally.
I know, right? I know. So if you want to, do you want to share your screen and go through the presentation a bit? And then
Absolutely. I can do that. 1 second here. All right, you should see that any moment now.
Yep.
Are we good? Okay. I'm just going to leave it on this screen mode as opposed to presentation mode, just because I've got a dual screen and it gets screwed up on Zoom. So hopefully this works. I think it's big enough, eh?
Yeah, it's big. Yeah.
Okay, good. So do you want me to just launch straight in? I think the plan was maybe 20 or 25 minutes of presenting and then some Q&A.
That's correct. Yeah.
Okay, sounds great.
Thank you.
Well, look, thanks, Jessica, and thanks, Adelaide, for hosting us. We really appreciate being here, and we love telling our story right now because it's obviously really exciting times in the patch. And I have to say, I've never been more excited about the future we see in front of us here at NuVista, but I've also never seen such a setup in my entire career. In terms of the scarcity of supply, the robustness of demand, and people don't even seem to quite believe that yet, and they're realizing it now. The energy security issues that are happening, and the fact that we've got the best of the best assets coming on into brand new empty facilities that we just started up, less than a year ago. So it's just an excellent setup. And in fact, it's all of the headwinds that we saw in 2020 have now turned into tailwinds. So as tough as 2020 was, as Jessica just alluded to, those very headwinds, because we were able to make it through, basically strong. Now we can thrive on the other side of what I call the 2020 Death Valley for our industry. So with that, I'll get jumped into it here and show you exactly why. So just for those that might not be quite as familiar with the company, we are a pure play Montney company. We've passed 65,000 BOEs per day. In fact, just our press release 2 days ago, 66,600 BOEs per day. On our way to an ultimate facility capacity of 90,000, and all we have to do is fill that up. So that's extremely exciting for us, simply by doing half cycle returns by drilling pads, repeatable high value pads right beside existing pads. And I'm going to show you that on the map sheet. So you can see some of our key stats there, about 2.7 billion in market cap. And you can see we've got lots of liquidity to execute our plans. And you can also see our updated guidance. And in our press release 2 days ago, we bumped our Q1 was a beat, and our full year guidance for this year and for next year was actually bumped upwards on the back of a capital increase as well, to take advantage of basically smoothing out our 3-rig drilling schedule, which I'll talk about. Of course, I am going to talk about forward-looking information, so please do take note of the advisories, and this presentation is available on our website. So, we are very focused on returns, and we think there's 4 key pillars to that. You have to have the best of the best assets and execution, and we think we've demonstrated that consistently. The newest one was Pipestone, our new area in the north that we purchased in 2018. Didn't really get to show how good it was because we had to hold back on capital spending through the pandemic. But then, of course, once we got back to it, the market was a bit skeptical that this property would be as good as we said it was. And I think now that we've been producing for a year, we have a number of pads online, the market has realized, wow, it's actually even better than you said it was. So that's been fantastic. Financial strength, obviously lots of liquidity now and growing very quickly, paying down our debt. So that's just not an issue anymore at all. Commitment to sustainability has always been important to us as a Canadian company. We're already punching well above the world standard, and we'd like to think we punch above the Canadian standard, and I'll show you something on that as well. And then an optimal growth profile. We really like our 3-rig strategy, growing 30% in production this year and a lot more than that in cash flow, obviously, and then about 20% into next year as we start to hit our plateau level of 85 to 90,000 BOEs per day with full and efficient facilities at that point. So let's get into looking at our map sheet a little bit. This is zeroing in on our area. And you can see here that basically we have a northern and a southern area. The northern in the blue rectangle there, the blue square, is Pipestone, and then in the south it's Wapiti. And Pipestone is our newer area. We've only been in there 3 years and 1 year, if you look at the two different blocks. And then down in the south, we've been drilling down there for about 11 years very successfully. And you can see all the gray hash marks, lots and lots of industry wells all around us. There are 4 benches, 4 zones in the Montney, and we drill them all. And so this is very important because that's why there's such a large inventory of wells to drill, is because you need 4 map sheets like this side by side to really understand how many wells you can drill, because we're stacking them in all the benches. And with the number of wells that you see on this map sheet, it gives you an idea of the well delineated position. This is not exploration. This is drilling known pads with known results right beside existing pads with known results. So very few surprises, except how strong the cash flows and the returns are. And so when you look at the numbers here, I could get into the details, but we've drilled about 250 wells so far very successfully on this entire map sheet on the yellow, which is our land. And of course, we have 1,200 to drill. And that's independently verified by independent reserves engineers, GLJ. And so as a result, we're only drilling about 40 wells per year to execute this growth program that we have. And so you can do the math there in multiple decades of locations, especially given that we only have a growth plan at this point to 85 to 90,000 BOEs per day. So highly valuable and a very deep inventory. This is getting to be old news now. This was our year-end reserves. We typically leave it in our corporate presentation until we do our AGM, which was this week. These metrics are eye-watering, the kind of thing I've not seen in my career. You can see big increase in PDP reserves, recycle ratios of 4+. And of course, that's at a reserve evaluator deck of about $65 to $70, depending on the year. So at current prices, just really, really high recycle ratios. And of course, that's one of the best metrics for an oil and gas company, because it's your net back divided by your F&D, which means what you're getting paid per barrel versus what it costs you to go and find it and drill it and bring it on production. So tremendous recycling of cash from the drill bit back into the bank. You can see on the bottom left-hand side some tremendous increases in PDP and 2P NPVs. And again, that's at the evaluator price deck, not at current prices, which are much higher. And huge amount of added reserves, more than twice what we produced in the year. So this is a brand new slide we just put in this week. We're very proud of this one, pretty excited. We actually had to come up with a new metric here because the paybacks are so strong on these wells in this commodity price environment. So this slide in the fine print, we've run this one at basically, we've sort of normalized the pricing to the April 29th strip for all the wells. And we put in the actual cost it took us to drill the well and the actual production we've gotten from the well. And each of those is actually a pad of 4 to 6, or in some cases even 8 wells. And so you're talking like a $40 million type investment. And the way to read this chart, the green radio buttons on the map is where we've been so far this year. And each of those is a 4 or an 8 well pad. And then the blue radio buttons is where we're going next, where we're currently doing activity and soon to bring on production. And you can see for all the ones that have come on stream on the right-hand side, the way to read this chart is, let's take pad B. So you can see only our second pad in Pipestone. It's been on for 6 months. That's the gray. It's only been on for 6 months. It's already reached a payout multiple of about 1.1. And so that means basically we've already got more than our money back in 6 months. And if you project the decline rate out to the end of 12 months, it takes you over 2 times. So we're going to get 2 times our money back. $30 to $50 million for these pads in the same year, the first year of production. So absolutely tremendous paybacks. And if you cast your eyes across, you can see, here's one that was on production for 4 months. We've already got 1.5 times our money back. These pads are paying back in 2 to 3 months in the current price environment. Absolutely tremendous. And if you just look at the whole list here, you can see they're all ranging from 2 to 4 times. Which basically means in the 12-month forecast for those wells that haven't reached 12 months yet, they have the light green on there. We're getting between 2 and 4 times our money back. So this is why we're able to start a significant return of capital to shareholders through buybacks, which we announced this week, at the same time as rapidly reducing our debt to our ultimate targets by year end. at the same time as spending enough to grow our production by 30%. Very rapid recycle of money from the drill bit. Very, very pleased with that slide and those results. I'll move through a couple of these other ones a little more quickly to leave time for questions. This is zeroing in on Pipestone North and South. That's that northern area, the newer one we're in. 1 year in the northern area and 3 years in the southern area. You can see we have a huge amount of room to drill more of these highly repeatable pads right beside existing pads, as I said. There's a long history that we have of cost reductions, and you can see that continued on the top right there from 2019 through to 2021. We've significantly reduced the cost per 1,000 meters for drill, complete, and equip. And of course, now we're forecasting some inflation. We can talk about inflation in the Q&A. We're doing, I'd say, better than most, but none of us are immune to inflation. And the reason our costs aren't going up much is because they're being offset by these continued efficiency improvements in drilling faster and fracking with less water. On the bottom right, you can see how quickly we've gotten after the production since we did start up. Finally got our new Pipestone area up in the northern area started up in 2021 there and have gotten after it very quickly. So very exciting there. This one I won't dwell on. This is the same chart, but it basically shows you drilling on the left, completions on the right. So it splits them apart and it goes all the way back to 2012, as you can see. So just a long history of reducing costs and now planning for a slight increase in overall cost into 2022, of course, with the inflationary costs that we're all seeing. Cycle time, again, I'm going to skip over this very quickly. You know, we've gone from, 280 days for the early wells where you're figuring out the area down to basically, and that's for a pad, down to 90 days. So we're 3 months to get a pad drilled, completed, and on production now. So extremely fast. Again, that money returning from the drill bit very quickly. You can see on this slide, this is an important one. So because we've built all of the facilities, this was the headwinds of 2020. We had to finish building our new facilities that we had committed to during the toughest of times when the oil price was at terrible levels. So we limited capital spending on drilling, but we did have to finish the facilities. We did that. And now we're in the enviable position of being one of the only companies that can almost double our production from 50 to 90,000 BOEs per day. 50 is what we were last year. Into existing empty brand new facilities because we had finished building them and then held off starting them up. So it's a very favorable position now because very few have that kind of facility capacity available, and it makes us more efficient as we go. So on the left hand side, you can see 85% of our money is going to the drill bit, drill, complete, equip, and tie. That's a very, very high return scenario because there's not much capital burden over top of what you're spending on drilling. On the right hand side, this shows the efficiency gain. And you can see we're gaining from over $20 per BOE cash costs. That's all in cost for operating costs, G&A, interest per BOE, and transportation. And it's falling all the way to the 15 range and less. So $5 to $6 improvement per BOE, which means if you have flat prices, you have a $5 to $6 per BOE margin improvement, which we think is a big differentiator versus a lot of our peers. So very exciting. The other thing I should mention for those of you that are watching greenhouse gas emissions closely, we have a great track record, which I'll talk about if we have time, but we have a significant improvement in our emissions efficiency per BOE, greenhouse gas emissions efficiency as we fill up these facilities to full because they're running at the most efficient point. We drive down our emissions per BOE in a significant and fairly similar manner to what you see on this chart here for cost. In terms of the type curves, again, a lot of details here. This is more if you want to run models and check that we're actually delivering what we say we are. There's a lot of analysts that do this. They run their own model. They take these numbers, they take our actuals that are published in terms of cost, and then the AccuMap results for the wells, and they verify. And I can tell you, we always come up smelling roses on that one. It's very important to us to deliver what we promise. And these are why we're getting these tremendous economics. So these are all the sort of inputs that give you in a $65 mid-cycle world, $65 world gives you in the range of 6 to 12 months payout on those pads, obviously faster in this environment. This is just a chart that shows our growth path. So we did build those facilities I talked about, and combined with downstream contracts and midstream contracts, we have a cradle to grave approach here where we know all the molecules can get to ultimate market, which includes the gas going all over North America. Of course, the condensate that we produce goes to be used as a diluent for the oil sands. So we're making it in Alberta, we're using it in Alberta, and that's why we get a premium for that price. And I should just quickly say, every well we drill, on average, 2/3 of the production is good, clean Canadian natural gas, and 1/3 is condensate, which is a very light form of oil that is used as a diluent for the oil sands. So it's the only domestic market we have. We're finally at the correct end of the pipe for something in Alberta. We don't have to ship our condensate elsewhere and pay the export pipeline tariffs to get there, like we do our oil and our natural gas to the US Gulf Coast, as an example. It's the other way around. It has to be imported. We're not making enough of it in Alberta. We get the premium price, and others have to pay the import to get it to us. So very favorable and part of the reason our economics are so strong. You can see this growth plan going all the way up to the 90,000 BOEs per day. And this pencil thin blue line is our minimum volume commitments, which obviously we're cushioned well above those numbers now, which is the plan. Basically, the growth plans I'm going to show you follow the top of the shaded blue area, obviously by design. And so this is what that looks like if you lay it out on about a 4-year plan. And you can see here from 21 through to 25, the growth. So the capital I talked about is right here. So this year's updated guidance is about $355 to $375 million of capital spend. Obviously a very small number compared to cash flow. It's less than half of cash flow, and expecting a similar spend next year. And then of course, as we plateau at 85 to 90,000 BOEs per day, you see the green dots here. That's the well count falling as we need to drill less wells to keep things flat at 85 to 90,000. So that's our current plan. But of course, with very high demand in the world now and the realization of the need for energy supply and the fact that we're having tremendous economics and we have a lot of available free cash flow, of course, we are also looking at plans to take it beyond 90,000, not ramping down from 3 rigs, keeping a disciplined approach of not ramping up rigs, but just keep it at 3 rigs and keep going past 90,000 BOEs per day in 2024 there. So obviously some early plans we're looking at, and the benefit there is we can continue to supply what the world needs at excellent price at the same time as significant return of cash to shareholders through buybacks or other means, which I'll talk about here. So just another couple slides and then we can go to Q&A, Jessica. So on this one, I just want to show, so with that CapEx and production profile I just showed you, this is what happens to debt and to cash. So you can see on the free cash flow side, we've stacked it up from $65 oil with $3 gas up to 85 and 4. That's NYMEX gas, by the way, and then current strip, which is even higher than that. And you can see we've got, $400 to $500 million of free cash flow, net of capital, net of the increased capital. These are eye-watering numbers we could never have imagined back in November when we did our original plan. And we really haven't increased capital much since then. So it's very, very exciting. And, if you kind of look over on the right-hand side, that's why our debt is going down so quickly. We all, as oil and gas companies, ended up with more debt than we wanted in 2020, even though we cut back spending significantly. And so we're now paying that down. We want to get down to half of pre-pandemic levels. And so 100% of our free cash flow is currently going towards debt reduction. But we just announced this week that we've achieved our first interim target, which was $400 million of net debt. That was achieved in April post-quarter. And since we're there now, we can begin to share approximately half of our free cash flow towards debt reduction, still reaching our ultimate debt target of $200 to $250 million by year end. And then the other half of free cash flow can be going towards shareholder returns. And initially, we think buyback of shares is the best valuation there for the shareholder. It's a permanent increase to your per share metrics. And of course, we're trading well below our NAV. We're very confident in the wells that are in our NAV to be drilled. And therefore, we think that's a great use of capital and return to shareholders. Now, obviously, when we get to year end, we'll have paid off our debt down to the minimum level of $200 million that we've kind of laid out there. very comfortably. And so even the other half of free cash flow can then be also deployed towards shareholders at that time or towards growth or anything else. But obviously lots of room to increase shareholder return there. And that's why heading into the fall and the winter, our board will be looking again at the buyback strategy and thinking about the potential for dividends or any other uses of capital. That's going to be important, and we will communicate that at the time. And so for 2022 alone, that same bar of cash flow, this is now total cash flow, not just free cash flow. So of course, the piece of that goes towards sustaining capital, keeping things flat, and then the growth capital. And then of course, this is that huge tranche I showed you of free cash flow available for a split between buying back shares and net debt reduction. So just a favorable position with a highly repeatable and deep inventory. We just think this is, I've never seen a setup like this in my career. I guess I said that at the beginning, and I still feel that way, absolutely. I guess the last two slides I'll just quickly show you are right here. So even though natural gas is it's 2/3 of our production, but only 1/3 of our cash flow, because our condensate, which is 1/3 of our production, is 2/3 of our cash flow, highly valuable product. But still, we want the best price for our natural gas. So these splits just kind of shows that we take our gas to the 5 points of North America. You know, we take it to Malin, California. We take it to Chicago, to Dawn, Ontario. Some stays in AECO, and some goes down to the U.S. Gulf Coast. So a very good diversification there. You don't have to guess who's going to have a cold winter or a hot summer. We get access to all of those markets, which is really, really important to us. And so the last slide I'll close on here is just, we have about a 40 or 50 page ESG report on our website, which please feel free to have a look at that. This is our best estimate on how you can get 50 pages onto one page. Not very easy, but just trying to show some of the highlights. I think, as a Canadian company, we take great pride in always having focused on ES and G, and we're making great progress in all three areas. And in fact, in our ESG report, we've set targets for the future for continued progress in all of these areas. And I can assure you, we are well on our way to meeting those. So very proud of the team and what they've done. And I'll just stop there and we can go to some Q&A, Jessica.
Well, thank you, Jonathan. That's a lot of information. We really do need almost an hour for most of these presentations. Again, you never probably envisioned you'd have so much free cash flow. Do you expect there could be another capital bump as well, just to accelerate filling your 90,000 BOE a day facility?
No, I don't think so.
No, you just bumped it. So, yeah.
Yeah, that's right. So no, I don't anticipate that. Like this bump allowed us to fill in our 3-rig program, and it's kind of counterintuitive. Like inflation is happening, and there's a lot of reasons for that, and there's risks in the supply chain of things not arriving on time or being very expensive. And it's counterintuitive that actually, we used to have 3 rigs with a few breaks built in so that we wouldn't spend too much money or grow too quickly. Things have gone extremely well, and actually windowing those rigs out to other companies and then getting them back a couple months later to maintain our capital budget, why would you do that, is what we said to ourselves when we're in a position where we have more than enough free cash flow to reduce debt and start returning to shareholders subject to TSX approvals, which is in our press release. And at the same time, we can drill 4 or 5 extra wells by bumping that capital, which we did, and also made some allowance for 5% more inflation than originally budgeted. And so that was the reason for the capital bump, is a bit more activity, fill in that rig schedule. And so now we're going at the absolute optimal schedule, and all the people will be coming to work for our rigs every day of the year for NuVista. All the casing, all the cement, everything is on a steady schedule now with no breaks planned into it. It actually enhances our safety, increases our labor continuity, and reduces the supply chain risk of, for example, swapping rigs in and out. So we're very happy with that program. Now, I alluded to going beyond 85 or 90,000, and I think we typically can find ways to debottleneck and expand existing compressor stations and so on to go beyond capacity once you get there. So we will be looking at that. The way we think about it is not adding rigs, though. It's continuing with the discipline, continuing with the growth, with 3 rigs instead of dropping it down to 2 rigs, which is what we'd need to do in order to just stay flat once we get there.
Well, that leads to my next question. If you can, we talked about this, I think last time we chatted, but you have the ability to expand those facilities, and I'm just wondering what the cost associated with that would be, and how, and to what could you expand them by, do you think?
Yeah, those are great questions. So we certainly have a deep enough inventory. We don't need more land to be able to expand, and so easily, a few more 5 or 10,000 BOE per day bumps. So very small bite-sized chunks compared to, say, the 25,000 BOE per day chunk that we signed up for when we built the Pipestone facilities. So and also now we're not a 45,000 BOE per day company like we were when we did that. 25,000 is a big bite at that time. Now we're going to be an 85 to 90,000 BOE per day company, planning some 5 or 10,000 BOE per day bumps. So certainly continuing the growth in a nice disciplined fashion, beyond 90 to 105, 110 is certainly well within the gun sights, and we'll have a good look at that. We're actually doing the engineering right now to make sure it's all underpinned, and of course we want to make sure we can continue returning cash to shareholders at the same time. In this environment, that should be quite easy. In terms of the cost for it, like our annual budget, we've bumped it to 355 to 375. So, if you kind of look in the out years, we would be dialing that number down to stay flat. In order to continue growing, we probably would be looking at still in the $350 to $400 million range, maybe a little bit more. It depends whether you build your own facility new, or whether all you have to do is expand an existing compressor station.
Yeah.
Does the midstreamer have space that you're tied into? If they need to expand, they don't actually charge you the capital, they just charge you a capital fee, so it's ratable, like we're paying on some of our gas plants right now. So it's difficult to answer until we do the engineering, but the short answer is, it's not like it would take our capital to $500 or $600 million or something crazy to continue.
No.
It's just going to be the ability to continue going and continue spending in the kind of range of what we're doing now.
Yeah, I was kind of trying to focus on how inexpensive it probably would be to expand by.
Yeah, I don't want to give a specific number, but just to give you some examples, like we can add a compressor or a dehy for like $10 million. Like it can be very small type dollars if that's all you're doing. But if you have to do a major expansion or a new compressor station, then those can be as high as, for example, we added 25,000 BOEs a day of capacity by building the big Pipestone North compressor station, and that was just over $100 million. So,
yeah,
it gives you a bit of a range, but that's a lot of capacity added all at once, which
sure.
We don't anticipate needing to do any more 25,000 type chunks.
Okay. I do have a couple more questions. Just you've brought down the costs on your Pipestone North wells, and is that a function of just having drilled more of them, you think, or better completion, placement?
Yeah, it's a bit of all of the above. So I'll just go, hopefully people can see that chart. So just a reminder that we weren't even drilling in Pipestone until 2021. We just sort of got at it. So we had a big track record since 2012 of dropping drilling costs, dropping completion costs. And that's from efficiency. It's from drilling faster. It's from fracking with more pumping hours per day and less days of pumping that you have to pay for. A whole bunch of efficiency type gains that we had gained before we got to Pipestone. We knew when we got to Pipestone, the cost was going to be less because it's a little shallower and the rock, Mother Nature, is a little kinder. It drills faster and it fracks more easily with less water. So we knew we'd have a structural reduction, and that's been part of what got us the big steps down into 2020, 21 here, drilling in Pipestone South and North. So it's a combination of things. Yes, the well placement, we've also adjusted. We've adjusted the way we do our cluster perfs. So it's really continued efficiency gains that have given us all of this, and then now being offset by some inflation. And I mentioned inflation, I should quickly say, we originally budgeted for 10% inflation in the year in a $75 world in November, and offset by 5% efficiency gains, so a net 5% inflation. And that came to pass for Q1. We were right on the money. We've added another 5% for the remainder of the year in this capital bump that we've already announced. So we feel like we're pretty comfortable with that in terms of finishing out the year.
Okay, well, that's great. And on Pipestone, I mean, like you say, you just basically started drilling in 2021. I think you have over 400 locations. Would that be about right in Pipestone North?
Yeah, it depends how long we make them, of course. The longer we make them, the less locations we need, but we get the same reserves. But yeah, I think originally I'd have to pull out our original documents, but our original amount that we had talked about was sort of 300 plus locations. And if you jump to our inventory slide, you can see the updated numbers from our independent evaluators here. So it's sort of 250 plus 139. If you look at proven versus contingent resource locations. And I'll just point out that we haven't booked all of our lands with contingent resources yet either.
Oh, no, for sure. You should have a big jump in your reserve report this year as well, I would suspect. So, well done. I think we're out of time now. If there's any other questions, because we didn't get to touch on a lot of other stuff, please email me at jessica@adcap. And again, appreciate your time, Jonathan.
Well, that's great. Yeah, time is always the enemy. Jessica, thanks for having
Well, when
me.
you have so much good stuff to talk about, as opposed
It's so exciting. It really is. Anyway, thanks very much to you and to Adelaide for having us.
No, we really appreciate it. Thank you.
All the best. Take care.
Okay, you too.
Bye-bye.
And next we have Rafi. Are you on, Rafi? Yes, you are. How's it going?
Excellent.
Excellent. So Rafi Tamazian's here with us from Canoe. He is the lead portfolio manager and an award-winning one at that. He's been in the investment business for over 30 years. And he also spent 13 years at First Energy as a fierce competitor. And
That's right, Jessica.
We're going back. But yeah, he's certainly is an expert on the space, and we're looking forward to hearing your insights.
Yeah, good to see you, by the way. It's been
Yeah, nice to see you as well. It's been a while.
Thanks for having us. And I can't recall exactly the last time I presented for you folks, but it was kind of in the, if I'm not mistaken, in the early stages of the pandemic. And at the time, I went into a lot more about our strategy and how we invest. But really today, I'm going to skip a lot of that. And I'm going to jump right into the meat and potatoes of what we think is how we think you need to think about this sector and what we think is going on in this market. And also due to my lack of technical abilities, I've got Vic there forwarding moving my slides. The first thing I want to talk about really is an understanding I want everybody to have. And some of these companies that have been presenting for you in your conference are demonstrating this to you probably, and you're hearing this a lot. But the market is not necessarily aware that the world of energy has changed dramatically in terms of investing in it and how we would have invested in it in prior cycles versus this one. And I think people really need to understand that this industry is consolidating, and there's one major group that's going to be developed that are basically these distributors of cash, if you will. And they're becoming massive, big manufacturers of oil, driving the cost of that down and building a bigger and bigger inventory. And they're going to slow down the volatility of how you would be perceived to own this sector. So a lot of people might think that the energy sector is a volatile sector. Well, it was. And there is going to be a degree of that in the junior sector. And I would call the juniors, say, under 50,000 barrels a day now. But anything over that has sustainability and the ability to actually create free cash flow, they're going to start distributing that. In fact, they have already started doing that. And so when investors come in and look at this sector today versus, say, what you and I were competing against, Jessica, that you were referring to, in those days, it was grow, spend multiples of your cash flow, grow your debt, crank your debt up, have these hockey stick curve commodity prices that you need, and grow your reserves per share over time, hopefully. That type of model is really not going to exist again. And it creates a lot less volatility when you own the sector. Now, if you go ahead there, Vic, to, I want to say, slide 6. Thank you. So these are the 7, the 9 subsectors that Dave and I look at the energy industry as. This is what makes it up. It's a very robust image of energy today. I think it's really important that people understand that energy is not only not a volatile industry to be invested in anymore, but that it is so many things in your life. It's not just the oil and gas producer. It's the transportation and the complexity of that. It's the exposure to a certain degree at certain times in what we call alternative energy and the technologies in energy. It's trying to invest at the right time in the services that will provide when the producers start to spend more in the basin. All of these things create a massive portfolio of opportunities. And we look at them all as these 9 different subsectors and we pit them against each other. And so you're going to kind of hear us talking in that vein when we're referring to the sector in this presentation. I'll take you to the next one. So let's go into this, the kind of what we think the current situation is right now. And appreciating that we come at it from these subsectors, I look at it more now, the industry, from where does it look relative to the other industries out there? We start with this very top-down approach. This chart on the left, there's a lot of stories that can be told by that. And some of them are tangible, and some of them you might call our behavioral economics that we use. So here's what you should read from that. The green wedge there is all of the money that has gone into the S&P, new money into the S&P that was not labeled ESG. So all the SPACs and all the new money that went into technology companies or maybe even lumber companies, whatever, it amounted to about $500 billion since back in early 21. ESG had got allocated, anything with an ESG label got $1 trillion in total. New capital went into it, okay? Now, the expectation was that there was a lot of guilt and a lot of fear that people felt they needed to contribute and invest in that sector. And they were also convinced that it was going to replace this dirty oil. So get involved early in this great new growth sector. And piles and piles of money went into it. Like I said, $1 trillion versus every other industry combined was $500 billion. Now, the problem is we can actually now assess what happened there. And the $1 trillion was thrown into a very small pile of names. And you can see as that money went into the funds, the fund managers just turned around and kept piling them into the same names, ramping up the values of these things. And they skyrocketed until the mid part of last year. Now they're all off kind of 50, 60, 70%. The valuations of your ESG funds have been decimated. And that you're sitting there kind of feeling the pinch from your investment. But at least you put money into ESG and they were finding alternatives for oil, right? Well, what we're here to tell you is the alternatives didn't show up. In fact, it looks like there was all it did is made us understand just how risky these experiments still are. And maybe it wasn't appropriate for pension funds to be putting money into these kinds of things, or even just your average person investing in it. This is more risky capital than everybody thinks. It's meant for much more, not the risk averse capital that did go into it. And so the money went in there, the money got devalued quite severely. The alternatives didn't show up. But I'll give you one more that's even more alarming, is human nature. And what we found in the developed world, where a lot of this money was put into the funds from the developed world, or the OECD countries, for the last 15 years prior to COVID, we had arrested our growth in oil demand. We were using the same amount of oil for the last 15 years. We weren't growing it anymore. We were growing our energy demand, but we were replacing that with natural gas. But up until COVID, we had stopped growing our oil demand. Except post-COVID, we're growing our oil demand in the OECD countries. What is that because of? Partly it's because people gave money to these ESG funds thinking that there was going to be a replacement. And so they went on continuing to use their oil. But not only that, we fashion it to kind of like when you go for a run in the afternoon, and then you go out after work with friends and you think, well, I went for a run, so I'm going to have a drink. Well, they go, oh, I've invested in ESG, so I'm going to use even more oil. And now the developed world is actually growing its oil demand again. And what's even worse is COVID took us from what we called selfless to a selfish situation. And the globalization experiment that we've been doing for the last 20 years started to break down. And we would argue the Ukraine war is actually the critical turning point that gave us the conviction that we're probably going back to the old world of East versus West, or developed and undeveloped, or OECD and non-OECD world. And that's very inflationary if we're deglobalizing like that. All at a time when we need to use our oil, and our reliance on our oil is growing because we are now using it more. 30% of the oil produced in the world is produced by the OECD countries, but we use 45%. It means we are beholden to the non-OECD or dissident countries that would be threatening our security. And that's why also in the medium term, as we see this security issue elevate, we think Canada's oil is eventually going to become very coveted in the OECD world. And that's a very positive thing. Now, what about the oil and gas producers themselves? What are they spending the money on? New money going into the market didn't go into it, as you can see on the left. But on the right-hand side, the activism and the anti-energy movement got into the super majors, and look at what happened after 2013. And we've been drawing attention to this chart since 2015. It was quite alarming when it was dropping. The super majors reducing their spending by 60%, 70%. And the primary focus of spending was on mainly building out refining. They weren't out trying to create any stability in the current production base they had, let alone finding any oil. And so we were not funding it on our side, and they were not spending any money. And that created both a supply, that's why we were in peril with supply. And to accentuate that, as I mentioned, the developed world has gone and turned it into a demand growth environment. Now, the developing world, the countries that don't have a middle class yet, or a healthcare system, or any kind of transportation infrastructure, these people got threatened by COVID, because while we were all finished our second shots and celebrating that we're going for our third, the developing world was at 5% vaccination. And they realized we weren't going to be there really to help them the way we said we would be. And you saw the elevated demand for oil right away. And then we had COP26 come along right at a time when it was already a sensitive issue about their survival. And we demanded answers from these developed worlds, what they're going to do about their carbon footprint. And they basically turned their back to us. And the demand for oil in the developing world is growing even faster pace than the developed world. So now we're at a point where we're using more oil than we were ever using pre-COVID. And on top of all that, we are sitting in a situation where we have no more spare capacity. So if you can go to the next slide there. And maybe one more, please, Vic. So on the left-hand side, this is just a peek at the US inventories. And that's the 5-year average is that white area, the 5-year peak line at the top and the 5-year low inventory average at the bottom. And you can see the red line is current. So inventories are perilously low of products and of oil in the US. And what's even more concerning is that the first quarter is always, you can see the slope up to the right. That's usually when you get your inventory builds. But we had a very onerous first quarter for usage, and we see ourselves actually depleting the resource. And now we're entering the period where you deplete it more. So it's going to accentuate the lack of energy available. We are now at a point globally where it's not just, you don't have to worry about just high prices for your energy. There are going to be situations in the developed world where you don't have the energy to provide for what you need. And in the developing world, when that happens, that creates carnage, chaos, and even civil war. So we also see elevated geopolitical issues now, which are also going to help start to, and that has never been priced into the price of oil. So we anticipate that that'll start to develop a lot more as well. If you can go to the next slide there, actually, and then this one here, what we want to point out on the left-hand side is what is the representation of energy to the rest of the market. In the US, in the S&P market, we were back when I did this presentation with you guys last time, energy would have represented about 1.8% of the S&P. That was the bottom of the cycle. Today, it's at 4.5% after all of that move. It's at 4.5%. And Goldman yesterday came out and said, it looks like energy represented 8% of the earnings reported this quarter. And it's only represented 4.5% in the S&P. Canada's a little different. It's a bigger part of our economy. So it's a bigger part of our index. Produces, the generalists have to own more of it, but they are reluctant still. We see enormous momentum of the generalists, both in the US and in Canada now, starting to crowd into this space. So we anticipate funds flow will be one of the bigger issues. That is also why it's probably prudent to maintain a fairly high upcap market investment exposure right now, for the simple reason that you can't be, you can sit there and want to play the junior sector, but until funds flow into the junior sector, it's a riskier place to be. And a lot of the new money coming into the sector today isn't just going to jump right into the intermediate and small caps. It's going to end up being basically focused on the large liquid producers. And that's where you want to start. If you can go to the next slide there. So here's some pretty good news too. So here's on the left-hand side, showing you the royalties that the energy industry pays the Alberta government every year, dating back to 1990. And you can see the average royalties paid over that period of time runs just under $4 billion. This year, we estimate that we're going to pay the government $18 billion in royalties. And that equates to, at a federal level, a pretty significant tax number as well. But I put this up here to have people understand how quickly things can change and how fast the debt picture changed. And now not only are the companies doing well, but it's contributing to the economy of the country as well. Very, very significant numbers. You can see the variability in 2023, getting up to almost 28 billion if you use kind of current pricing. You can go to the next slide. So this slide we put in here, but I'm always reluctant to show it because it does show that we're early in the cycle. But the previous energy cycles that are shown on here have these they are cycles that were built off of an energy sector that was spending multiples of its cash flow, ramping up its debt, issuing equity, hockey stick curve projections for commodities, all of that stuff that I mentioned earlier. But remember, the industry has changed. The junior sector might look something like this a little bit, but the intermediate to the large cap group, who are going to be these consolidators of assets, driving the cost of the oil down and distributing the profit back to you, they're going to become more like manufacturers, and the market is going to modify their impression of them from a risk perspective. And we think the group is going to maintain a much higher base level of value going forward, and their volatility up there is going to be far less from now on. The key will be if the producers maintain the discipline of being distributors. And we think they're almost forced to because of the lack of services available anyway. And we're going to talk about that quickly right away as well. If you could skip this slide, the next one, that right there. So what are we currently positioned in? Currently, we are a little concerned about the producers and their ability to control costs the way they have to this point. There is enormous pressure on the companies to try to grow their volumes. The only volumes that can really be grown is anything that doesn't involve a lot of infrastructure, because the government has made it so onerous to build out longer term infrastructure that you won't see any longer term stable volume growth. You're going to go after the shale production, and that's going to be the quick stuff that'll have high declines. It'll need a bunch of capital, and hopefully it'll alleviate some of the supply pressure we have, but it's going to wipe itself out just as quickly as it comes because it declines hard. But if we do put the money into that shale production, we're going to have to put it into the services that hardly exist out there anymore. And so those services are going to start to charge more for their business. So the first thing we're doing, if you go to the next slide, Vic, is we're going to chase these producers that are resilient to costs. And that would be your royalty companies typically. So Topaz, Freehold, and Prairie Sky are good examples of that. And these companies don't get affected by the costs, other than maybe the activity level of the producer might be hurt by it. But really the direct costs are on the producer. These guys get their royalty at the top line. So we would recommend, and we've been building our positions in these groups here, as we've brought down some of our exposure in the more conventional producers. And in turn, the next slide, if you could, in turn, what we've done is we've said, well, if that capital, that all that free cash flow is getting distributed to us, pay down debt, and the rest going into the field, that service company is going to grab some of that profit. So we've been slowly moving over the last 45 days into the service subsector, primarily in the pumpers, and just because of the barriers to entry and the focus on that short cycle oil that we know we can get out of the ground quick, although it is going to create its own problems, a problem of its own. The last slide I want to show you, not this one, but the next one, if I could, is just I want to finish with our alternative energy and energy strategy, energy technology strategy. We think there's almost $60 trillion that's going to be spent in silly government spending in a bunch of these areas that are listed here. And when Dave and I did an analysis of this area back in 2015-16, we recognized a few key areas that we could probably put some money to work in, primarily in areas where we could use our expertise in developing businesses that could help tackle the problems that this dumb money was creating. We saw the wind and solar build out. We saw the inefficiencies. And so we did a bunch of research on battery storage. And we ran into this bulk battery storage business. And that was 5-6 years ago. And it was a concept that was built out of Toronto, a business in Ontario. And it was basically a glorified compressed air energy storage strategy. But he had captured a technology that made it convincing to us to take it down that road. It was a 30 million market cap at the time. It wouldn't have required a lot of investing. Well, as it turns out, they ended up
I think you froze there, Rafi.
yeah, here we
Yeah,
go.
okay, there we go.
There we
Yeah.
go. I'm back. Sorry. What ended up, it turns out, happening was we incubated that business for 6 years. We built out even a test project in a place called Godrich and helped fund that. Put all the effort, our time with the fund's capital into something that was meaningful, that could try to impact and change the economics of windmills and solar panels. We're not greenwashing with your money. Fast forward today, and Goldman Sachs Private Equity announced 250 million US investment in this business. CPP has leached their investment out of that Goldman fund and announced it separately for themselves too. The difference is your early cost base was 30 million market cap. It's now got a 200 million market cap. So we got into a fairly healthy, alternative energy strategy with your capital and trying to move the needle. Another one would be a water recycling business, that taking Canadian water recycling and transfer technology that we are very, astute with, and transferring it into the Permian in the US. And that was a business that was generating 7 million in EBITDA when we invested in it 4 years ago, all of it in Canada. And now next year they're talking about 20 to 26 million of EBITDA, and 60-70% of it'll be out of the Permian. And it's Canadian technology creating water recycling mindset in the Permian in the US. That's our capital put to work, making real things happen in this sector. But if you go to the last slide here, Vic, these are the positions that represent our alternative energy roughly. They're 12% of our fund's assets today. And quite frankly, that's how much you should have exposed in that sector right now. You should not be aggressively pursuing these experiments. The stuff we put the money into was stuff that we worked on over that 5-year period when there was a dollar was competing for energy all over the board. It's really hard for a dollar to compete with anything but what's happening in our backyard in the fossil fuel industry today. You want to be heavily weighted in the energy sector, the conventional energy sector, and we're planting the seeds for the next cycle with some of these things that you see on this board for the next alternative cycle. Anyway, that I'll leave it there. I don't know, Jessica, how you want to go about it. Do you want to take questions or?
Well, there doesn't seem to be any questions from the audience at this moment. I had if there are any, people can certainly throw them in the Q&A box. You answered a lot of the questions I had prepared. One was certainly on the service side, which we're seeing in Canada and the US, from what I understand. Shortness of frac crews, things like that. And, I was reading just the other day that they don't think in the US they'll get past probably 800 rigs. And at, the peak, we were close to 1,200. And even with the ducts that are being brought on, they're declining quickly. So the production growth that people were hoping for out of the US is likely not a reality. I'm
actually in Halifax today, and I'm speaking to clients, and one person asked me a question: what would it take to bring on 1 million barrels of new production in Canada? And I was just like, 1 million barrels? That's like a pipe dream. That doesn't even.
Yeah.
And I just said, first of all, any 1 million barrels that a producer is going to take the risk to try to add. Well, the big projects can't add anything. You can't add any oil sands projects because we've regulated the industry so heavily. It's punitive because we don't even know what the cost of it's going to be. Look at the pipeline cost for TMX. It's ballooned to over $22 billion now.
Yeah,
That's why
and
Canada didn't want to do it.
yeah,
Right?
and the government said we're not adding any more, we're not giving any more money, even though they've guaranteed a loan. But, and then I just saw, I think today, and this is one of the things I've been hearing from US investors is that, even like pipeline gathering systems and, shorter pipelines are not being approved as well. So why would you build out drill new reserves if you,
how about this one, Jessica? That now we're being accused, the industry is being accused by politicians about gouging at the pump.
oh yes, I love that.
They're
Yes.
correlating it to the profit that the producer's making.
Yeah.
And Jagmeet Singh is publicly stated that, and he uses these egregious terms like these filthy rich billionaires in oil and gas. Shame on them while you can't afford the price at the pump. I'm telling you, this is the leader of the new Democratic Party, and that is the most irresponsible statement as a human being. And he has an obligation to be more responsible than that. It's shame on him because that oil, it's a supply issue.
That's right. He's completely uneducated on and yet feeding bullshit to people who don't know any better.
But I'd be curious from you, having come from, as you said, my competitor, and understanding the energy cycles of the past. Does it make sense what I'm saying, that the industry's in a transition?
Completely. I like everything you said. I concur with. Like it feels different. It is different, and I've never I've been doing this for 26 years. We've never had this lack of supply before.
Yeah.
Right.
No.
And the lack of funding for these companies.
And when you have a lack of supply like that, it trickles down into the refiners. And now the products are also getting more expensive. So look at diesel today.
Diesel, I know, I was just about to say, which then increases your food costs like even more than they already are. I mean, we're gonna have food supply issues that are.
Well, that reminds me, I want people to think about this too. Don't forget, inflation is two things. Absolutely critical when people talk about inflation. There's going to be now talk about the possibility that inflation has peaked its growth. Think about inflation like the one that is affected by the supply chain issues and the chip shortage. And then think about inflation from the old economy stuff and the lack of spending we did on those things. I don't care what you fix on the supply chain side of inflation, you're not fixing this one.
No.
So if people correlate this one coming off and the market trades off the whole cyclical group, buy the hell out of that group in weakness.
Oh, definitely. I mean, it reminds me of after the tech blow up, but even worse, right? Because of these, when in 98, OPEC had 12 billion barrels a day of excess supply, right? And they cut production, and then we did have, natural gas prices improve because of changing to cogen and everything else. But, we've not seen anything like this in my lifetime. And people totally underestimated. Like, I don't know how Germany turned off their nukes and everything else before determining whether or not their alternative energy would work.
Well, I have numbers on that. This is impressive. If Canadians are feeling real proud of our initiative to try to be green, well, let's just look at the first experiment, and that was Germany. And they started the process that we're on back in the year 2000. Yeah. And they started this push to go to zero alternatives or zero fossil fuels by, it was originally 2015 or some stupid number. Then they pushed it out to 2030. Now it's like 2050. At the time, they were producing 85% of their production of their energy usage was created by fossil fuels. 22 years later, this year, they're announcing they have to raise the usage of fossil fuels because of the dilemma with Russia.
Mhm.
And
I know. It's insane.
they managed it. And where are they at this year?
Mhm.
They're at 76%.
Mhm.
So in that 22 years of stupid experiments and pissing away money and all these wind farms that are useless, they managed to go from 85 to 76%.
Yeah, what a win. What a
Yeah.
win. And the trillions of dollars that you've spent doing it.
Well, so
Yeah.
if it's really a race because of the global warming and man-made issues, we're losing the battle.
Yeah.
It's not
Yeah.
working. So
Yeah.
we've got to figure it out another way. And I'm pretty sure it has to do with accepting oil is a part of our lives and we got to clean up the emissions.
Mhm.
That's
I
much
agree.
more likely to be a scenario that will achieve the goals everybody wants than these dumb experiments that have produced nothing. So,
And like you say, these companies that were high risk, should never have been invested in by low risk money. And now that's been a disaster. And, it's just I'm in total agreement. Everything you've talked about today, I completely agree with you. And yet I still haven't seen that massive inflow of capital yet from the generalists and bigger funds. Yeah,
well,
it's starting.
So,
It's starting.
So now you'll see the inflow of capital. And then the next phase, when this sector gets a value to it, you'll actually start to see a capital program start, a significant one.
Yeah.
Let the service sector beef itself up for the next 18 months. By the middle of or end of next year, maybe you'll see a capital program, for instance. We might even see new equity markets possibly, Jessica, and in that sector, which we will not see early like we typically do in this business because they're right now cash machines.
Yeah, which we were fighting each other. Like you say, they were just on these growth trajectories, raising money 3 times a year, and it was, phenomenal.
That's how we make a living, yeah.
Yeah. But no, I think, and one question I had for you on gas, how do you, I see you're more bullish on oil than you are natural gas. That's contrary to a couple of people I've talked to, and I'm just was wondering about your view there.
Yeah, I don't know if I'd say I'm negative on gas. I'm just more bullish on oil, I think. I think you should have exposure to both. I think that only recently, where we saw massive pricing of gas in certain pockets of the world, you could see Canada and North America's gas price rising almost as a derivative of those places.
Yeah.
That is because LNG infrastructure is growing at such an aggressive pace. Gas is now becoming a global commodity.
Yeah.
And we're on the doorstep of that. So for that reason, I feel very good about the sector. But there is a seasonality to it still. I can't, no matter how much you rip that out of me, all my life, I've lived with seasonality with gas. So just
exactly. And summer always disappoints us.
Yeah.
And
yeah.
yeah.
So that's, I'm going to preface that. Yeah.
Now, there was one question from the audience. With an absolutely dismal record of companies setting hedges and collars, why are they continuing to do so?
The first one, the abysmal reporting from the first one, it's only fair to say that if you can not use hindsight, you have to appreciate where these companies were when they put those hedges on and the environment we were in at the time.
Yeah.
And it was to secure a program, and it was just mind-numbing that the companies could actually see that they could make a profit even with a hedge. So we criticize the companies with the hedges now as they're coming off, but you really shouldn't use hindsight. You need to actually, it's such a low form of intellect, eh? Like you have to go back and appreciate what those companies were doing then.
And there was only a few companies that I can think of that really blew themselves up with bad hedging.
If you do it right, you're protected. I think the second part of the question is a valid one. Why are they doing it again?
Yeah.
And I'm not a fan of that because if you do lock in like that, you've got to respect if you are one of the bigger producers, and you are a cash machine now, you're fixing your valuation to the market for the rest of the year if you do too much of a hedge.
Yeah,
Yeah.
yeah. And I mean, and really a lot of the hedges last year were forced by banks. So
That's right.
in-
On top of that, which is a lot less now.
yeah,
Well, hell, they're all debt free. They were all bankrupt 2 years ago, and now they're all debt free.
yeah, zero equity values 2 years ago. and yeah. And now the banks want nothing to do with them because they signed on with Carney's deal.
And remember, yes. Oh, you're gonna go there, are you? Tease me. So that's I think we have to appreciate that the sector is also going to be separated into these two parts, these money distributors and really methodical growth businesses. And then there's going to be the junior sector. And the junior sector will be this volatile thing, I think, that will kind of still resemble the thing that you and I were part of in the 90s and the 2000s, early 2000s. But the vast majority of the production of the country is going to be tied up in these 15 or 18 behemoths that are distributing cash out to you. And just remember where you're putting your capital and what risks you're taking in it as this market matures and develops. But I want to make sure people understand that the risk you're taking today in owning the sector, with what we know now about demand being out of control and supply being in peril, versus a year and a half ago when these stocks were 500, 600, 700% lower than they are now. That sounds silly when I say that.
I know, right?
Yeah. I would say on a risk adjusted basis, they're cheaper to own today than they were then.
Yes.
Yeah.
Yes, they are.
Yeah.
Yeah. And I've never seen valuations so low for these companies.
Yeah.
One last question before we leave. We could talk all day probably, but given your bullish outlook, what's your biggest concern about your thesis?
Yeah. So what's the downside if we're wrong? It's all the only one I can really, obviously there's ones that we can't figure out, like government interference which is, that's a risk we carry in Canada. But I still think you should be focused in Canada right now and taking that government risk. And the other risk you would have is, I hope I dispelled anybody's, well, I mean, we didn't show you the factual side of it, but the data that comes with our thesis that supply is in peril.
Yeah.
That you can't just turn a tap on, that OPEC has no more capacity. In fact, they're falling short.
Yes.
So
I mean, you see the numbers every week. Like,
the only place you can derail this is in energy demand.
Yeah.
And the kind of significant demand destruction that you need, it's so enormous that I'm talking about a recession that your energy investment will be a rounding error in your life to your other problems you have.
Exactly.
So the downside is mitigated when you think about the kind of extreme situation I have to paint for the demand destruction to occur to actually affect this sector negatively.
Yeah, totally agree. And I'm more bullish on Canada than the US. Are you Canadian stocks versus US stocks?
Yeah, I am.
Yeah.
I think that we are ahead of the US in cleaning up our businesses because we were forced to start to clean our businesses up back in 2015. These guys didn't hit the ground running until 2019. So they're more levered and they're a little more fat on the businesses. The margins aren't as prolific. And so Canada tends to be the place you want to focus on more. Although our energy service investments, we're including Halliburton and Liberty and a few other US investments. So it takes our US exposure up. I think we run about 15, 18% US exposure.
Yeah. Okay. Well, that's great. Very insightful. We really appreciate your time and nice to see you again. Maybe we'll see you in person soon.
We can get back to Calgary.
Yeah, get out of Halifax. Yeah.
Yeah.
Well,
think I'll
thank
be in
you.
Toronto next week, actually.
Oh, are you?
Yeah.
Okay. All right. Okay. Well, have a great weekend, and thank you for everyone for your time. And it was great. Really appreciate it.
Take care.
Okay. You too.